Okay, so this is our next speaker, well, first speaker really, but is Josh Knight, who's an old friend of the Specialist Mortgage Web Show and when we used to do our road shows as well. Josh's been around a long, long time, really does know his stuff. One of the nicest guys I've actually met in the industry as well, but really does know his stuff. And we're a lender that is also one of the most proactive in getting cases through. An excellent lender to deal with. I think he's mainly talking about bridging today in his presentation. So you've been sent today a lending guide for Octane Capital. It's a 3-page document, I believe. So that's come in an email to you today. If you haven't got it, email Kylie, who you've probably been in contact with already, or you can email me and I'll forward it on to Kylie and we'll get the documentation over to you. A little bit on Josh. He joined Octane in February 2018 from Mariana Capital, where he was head of sales. He has over 10 years experience in managing intermediary relationships across private equity and property finance during his time at GMAC RFC, Octopus, Mariana Capital, and now Octane. Josh has a real passion for property finance, having been exposed to startup packager and lending businesses from a young age. He enjoys the challenges the specialist property finance market presents and likes to work on difficult scenarios. Fantastic lender. Honestly, if you haven't heard of this company before, then get in contact with me this afternoon. I can talk to you about exactly what they can offer your clients, because there will be clients at the moment, if you're not aware of them, you'll be turning down and turning away that you could be helping. My second presentation later just shows one particular example where the introducer earned over 30 grand from a deal that he was about to chuck in the bin. Josh's interesting fact, and I think this is fantastic, I really do. In May 2020, Josh completed 5 marathons in 7 days and raised over £4,500 for NHS charities together to support NHS workers and volunteers on the front line of the coronavirus pandemic. I mean, 5 marathons in 7 days is absolutely, I couldn't even think about doing that. I get out of breath walking up the stairs sometimes. Josh hasn't appeared. I know he's actually down as he's in as a delegate, but he's not appeared as a speaker yet. So I'm hoping there's not an issue. We do test everyone in the days preceding the show just to make sure that everything's fine. And Josh has never had a problem before. So I'm really not sure what's going on. No, it doesn't appear to be. I'm really hoping that I'm not going to have to do his presentation for him like I did for Together last month, because Together I could just about blag. I don't think I'll be able to blag Octane's presentation. So, right, he's just reappeared. I think, no, he's just gone again. There he is. Josh, can you hear us?
I can hear you. Can you hear me?
Fabulous. Yeah, the heart's beating a little bit. I'm thinking, oh no, not
sorry, that's my fault.
Right, okay, don't worry. Right, over to you. And I will see you in about 20 minutes.
Good stuff. Thanks very much, Tony. And hello, everybody. Thanks very much for having us on today. We really, really enjoyed doing these events. As Tony mentioned, my name's Josh. I'm a senior BDM at Octane Capital. I've been doing this with Octane almost since we first launched. And hopefully we can give you some value on one part of what we do. Anyone that's not familiar with Octane, we are a specialist unregulated lending business formed in early 2017. And in that short amount of time, the 5 years or so that we've existed as a company, we've lent £1.25 billion. And that's something that we're really, really proud of. We've scaled the business incredibly quickly. And I think there's a few different reasons for that. One of them is that we're well funded. Octane are a joint venture with our funding line, an entity with significant assets under management. They own a significant stake in Octane, as well as being our sole funding line. And that sort of stability that having a substantial funding partner gives us, I think gives brokers a degree of comfort that, you know, we know how our loans are going to be funded long before they submit an inquiry. The second reason is that people know our founding management team pretty well. Jonathan Samuels, Mark Posniak and Matt Smith, who you may be aware of, are the 3 original founders of a company called Dragonfly Property Finance, which sold to Octopus and became Octopus Property. And that was their venture before starting Octane. So people kind of knew and trusted them. And finally, it's because we do things differently to other lenders, and we'll talk about some ideas of how that works in the next few slides. We've won a few awards along the way, which I won't bore you with because they're on the screen. But you know, it's nice to get some recognition for what we do. Octane do and always have done since I joined the business 4 things. Three of those that you can see on the screen, you can put under the banner of bridging. So bridging, developer exit finance, and refurbishments. And then we also do specialist buy to let, and that's a really big business area for us, but we're not focusing on that today. For the purpose of this presentation, I'm going to focus on developer exits and refurbishments because I think that will give you the most value. We're a bridging lender. There are hundreds of bridging lenders out there. It seems like a new one's popping up every day. So we do bridging. But developer exits and refurbishments address more sort of particular problems, and we do things differently in those spaces. So I'll focus on those two in this presentation. So refurbishment finance, what do we mean by that? Well, firstly, we aren't a development lender. So we don't do development finance. So if you've got somebody that's building something out of the ground, that's not a project that we can help you with. But if you've got somebody that owns or is buying a property that they are changing in some way, or converting or improving, I listened to Tony's introduction where we spoke about the EPC challenge and what opportunity that creates for the broker community. Perhaps they're buying a property that has a very low EPC rating that needs to be improved. They're the sorts of projects we can help with. We lend up to 75% towards the current value, and we fund 100% of the cost of the works. Now, a really important point to note, and you'll see I've put it in bold here, is that we don't retain any interest from our day one lend. So when we say to you, we give you 75% towards the purchase price, that means your client gets 75% net in their pocket towards the purchase price. Well, very close to. The only thing that comes off it is the upfront fees. And that's different to how most bridging lenders do this sort of thing. Most lenders will retain 12 months or so interest from the day one lend. So your 75% becomes more like 65%. So it has a big difference to the amount that your client has to put into the deal. In addition to the 75% day one, like I said, we fund 100% of the cost of any conversion or build cost or refurbishment works. And that refurbishment facility, your client would draw down on it throughout the term of the loan in drips and drabs as and when they need it until the project is complete. Most people draw £20,000 to £50,000 each time, and we fund it in arrears. So your client would spend the first 20 grand, we would reimburse them, and so on until the project is complete. We only lend in mainland England, and our minimum day one lend is £200,000. We've recently slashed our rates, so this is really good timing that Tony asked us to jump on this presentation. Our refurbishment rates start at just 0.65% per month for what we call normal sized loans. So that's, buying a property for 300 grand, spending 100, and it becomes worth 500 grand at the end of it. However, we have a real appetite for big loans. So if the loan goes above 1.5 million, our rates then start at 0.55% per month. So really keen rates, especially for those bigger deals. Experience, you don't need to be the world's most experienced developer. In fact, we would lend to you even if it was your first project. So you don't need any experience to be considered. And the project is overseen by somebody that works for Octane, an Octane asset manager. There's never a QS. We would normally send our asset manager out to site to meet the borrower each time they want a drawdown. But it's a pretty seamless process. It normally just takes a few days to access the money. Suzanne, in answer to your question that I've seen pop up, no, we don't lend in Wales. Mainland England only is our locality. So that's the boring stuff. That's the criteria bit. So this is the more kind of exciting bit. Where are the opportunities for you? And the way I sort of see the refurbishment market, I see it as a scale from light to heavy, which I've tried to display on this slide. We will fund any refurbishment project as long as the cost of works doesn't exceed 100% of the current value of the property. That's our limit. Anything over that is too heavy for us. But anything within that, we can look at. And that starts on the left-hand side here, light refurbishments. So anyone just buying a property that needs a new kitchen, a new bathroom, a decorative refurb, maybe they're buying it at auction, maybe it has a poor EPC rating, that sort of thing, well within appetite. And as we move up the scale, loft conversions, rear or side extensions, whether planning is needed or not, we can help either way. And again, another move up the scale. Most of the business we do in this area is house to HMO, house to flats, or semi-commercial conversion projects. In fact, most of the business I personally do is house to HMO. Borrowers and landlords that are just looking to improve the yield within their portfolio. And then finally, up to the heavier side of things, commercial to resi. So anyone doing buying an office, converting it into flats, or maybe doing a basement dig to significantly extend the floor print of the property, we can help with all of the above. 75% towards the day one value or the purchase price, 100% of the cost of the works. And remember, no retained interest from the day one lend. And this is a worked example. This is our sort of bread and butter, if you like. This is a house in East London. The guy that we lent to was buying it for £650,000. It had planning permission to be converted into 3 flats. The cost of doing that work would cost him £250,000, and the end value, the GDV, once the works are complete, was £1.25 million. This particular guy had done a couple of projects before, so that was useful. So we lent 75% against the purchase price, so 75% towards the 650,000. And you'll see here, I'm at risk of labouring the point. That works out as 73% net in the client's bank account towards the purchase. So that's a really important point. We never retain any interest from that day one lend, and it really helps because borrowers don't want to put lots of cash into projects. They'd rather keep their cash and look at multiple projects at once. In addition to that day one lend, we also fund 100% of the build cost. So you draw down on that refurbishment facility as and when you need it throughout the term of the loan. Typically, we do a 12-month term. Normally, it's a 2% arrangement fee with no exit fees. And the rate in this particular case was 0.68% per month. Hopefully that will make sense. I'm going to whiz through the next few slides to make sure I don't go over time. So that's refurbishment finance. Anyone that's got any questions on that, will have time to go through them. Now let's talk about developer exit finance. Now you might hear bridging lenders talk about developer exit as a sort of separate business area. Well, in fact, I'm doing it right now. But a developer exit loan is just a bridging loan. It's no different in terms of how it's structured. The only difference is that it's used for a different purpose. The idea behind a developer exit loan is that if somebody has built a property or multiple properties using development finance, we often find that they need more time to market and sell, or maybe finish, market and sell their units, and they need to exit their development finance. So that bridging loan is just used to refinance the development debt and give the borrower the extra time that they need. Now, we will do developer exit loans on any new build property in mainland England. We can look at big multi-unit properties, so 100 units or more would be no problem for us. Minimum loan is 200,000, 75% is the maximum loan to value. We will do cash out day one. So if there's enough equity in the development where we can clear the existing debt and give them a capital raise on top, that's fine. And cash out on every sale. We will allow a cash release on every sale as those units are sold off. And I'll give you an example of that in a minute. As you can see here, our rates are really competitive, especially for larger loans. Another example of that in just one second. A developer exit loan will follow. An individual that wants a developer exit loan will normally be for one of four reasons. They either need more time to finish the units, more time to sell the units, they want extra cash to work on a separate project, or they're not sure whether they want to retain or sell those units. And we can help with each of those scenarios. So for example, if you need more time to finish, we will look at part complete developments, but they have to be right at the final stage in order for us to look at it. More time to sell, that's the most common one. They built the properties, but they just need more time to market and sell them. Cash release, remember cash out day one and cash out on every sale is totally fine with us. And we also have a hybrid bridge to let product, which allows borrowers to sell some and keep some. Not enough time to talk about that today, but we have a solution for that scenario. Final case study from me, and this is to date my biggest completion at Octane. It was actually a couple of years ago now, so I'm still dining out on it, still mentioning it in the hope that more £10 million deals fall on my lap. But it was a great deal, good example of how a developer exit loan works. This guy had built 52 properties on one site in Ickenham, which is just sort of west of London. He had sold 17 of the 52, so he had 35 left. They're all on the market. They're all being actively marketed. But the issue that he had is that he had extended his loan twice with his development lender, and they were putting real pressure on him to be repaid. He owed them £8 million against 14.5 million of security. That was the value of the 35 remaining units. Now, he just wanted to get his development lender off his back. They were threatening him with enforcement action. They were saying they're going to come and repossess these properties. And in addition to that, he also wanted to capital raise for his next project. Ignore this GDV here. That's just an extra line that shouldn't be there. So in this case, we lent at 75% loan to value. So 75% against the £14.5 million gave him £10.8 million. Easily enough to clear the £8 million of debt. And it gave him an extra couple of million on top as a cash release so that he could go and work on his next development. In addition to that, we said that every time he sold one of those 35 remaining units, he could keep a proportion of each sale. And that's a really important, we have found that that's a really important point for developers. Cash flow seems to be all important for developers. So allowing them cash out every time they sell a property can really be attractive. In this case, we did a 12-month term and we agreed to reduce our arrangement fee to 1% with no exit fees. We're really flexible when it comes to arrangement fee and prop fee split. So totally flexible on how that looks. And our rate was just 0.58% per month. Just finally from me, we have a large loan rate discount. When a loan goes above 1.5 million, I genuinely think you'll struggle to find a bridging lender with more competitive rates. Rates in the 0.5s, even at 75% loan to value, are genuinely attainable. Hopefully I haven't gone over. I don't think I have, but yeah, please do ask me if you've got any questions.
Absolutely fine, Josh. No, you're well within. I went over. You haven't. So you've actually made up some of the time that I wasted.
Good.
Nonsense.
Good.
Great, thank you, Josh. Absolutely great. There's not that you've already answered the one question we got so far. There's no question, so I'm going to give you the two questions you've already asked yourself. So to make sure I actually answer the right questions, not another lender's questions. How does your interest work on refurbishment loans?
Yeah, I think I've mentioned this. The answer to this about 75 times, but let's do it once more because it is important. When you get terms from a lender, you'll see their gross loan and you'll see their net loan. And the difference between those two figures will depend on whether they retain interest or they don't. Most lenders do. And that means that your net loan figure is often quite a lot lower than your gross loan figure. We roll interest. Interest is all added to the loan. So that means that your day one net loan is much, much higher comparatively to other lenders. So it means that we can lend at 75% net towards the purchase price of a property.
And you would not believe, delegates, the difference that makes actually between retained and rolled up interest. Have someone who's actually written a program to quote on bridging loans, let me tell you, it makes a huge difference. It really does make a huge difference. And a lot of people out there don't realise it, unfortunately. So, okay, that's the first question. Your second question, how does repayment work on your developer exit loans? I think you might have already answered that one as well. But
yeah, so typically speaking, when you do a developer exit loan, most lenders would say every time, they would have the sort of mantra, as soon as you have sold one of these properties, you've got to repay us as quickly as you can, and we just want to be repaid. Whereas we actually would prefer it if the loan went on a little bit further because it's a bit stickier for our loan book. And we also understand that developers really like cash flow. So when they sell a property, we wouldn't expect all of those sales proceeds to come to Octane to repay our loan. We would allow them to keep some. And that just means that their cash flow position is improved throughout the term of the loan.
Okay, so delegates, no questions. So Josh, you've either covered it all or there's always the other alternative, which I don't want to mention. But no, that's absolutely brilliant. Thank you. If you haven't used Octane before, we have package of status with them, as we have with pretty much every lender we deal with. Give us a call and we can see what we can get through for you. We do have some examples later on my second presentation of stuff we've done with Octane. And that's the first presentation I've ever heard Josh do where he's not mentioned 100% rental cover.
Well, we did do buy-to-let this time.
Yeah, that's the buy-to-let one, but that's another one. That's for another time. So, but like I said in my introduction, if you've got any cases, any buy-to-let cases that you're unable to place because the rental, especially if they're in London, the rental cover is just not there. Normal 125%. Give us a call. Great example coming up of how you could be earning tens of thousands of pounds from deals, potentially from deals, just by making a phone call. Josh, thank you very much indeed. Well ahead of time, which is fabulous. Simon will remove you from the room. Don't close it down yourself, otherwise you could shut down the entire thing. It has happened once. But good to see you again. We'll see you soon.
Thanks, Tony.
Cheers. Okay, on to our next presentation. And I'll go straight into it because I know he's about to enter the room, I believe. Yes, I think he is. So we have Matthew Batte from Pepper Money. Pepper Money is actually the second charge side of Pepper Money. It used to be called Optimum Credit. There he is. Matthew, how are you? Can you hear us?
I can hear you. Can you hear me?
Absolutely loud and clear. Perfect. Right, okay. So quick introduction on Matthew. Matthew joined the world of finance back in 2007 and has worked as a broker in second charges for 11 years. And I realised, and I emailed him last night, I realised we actually did business together back in 2007. Just before everything went pear-shaped. So still in the market, which is good. Before joining Octane Credit, now Pepper Money, he worked at Shawbrook Bank as a senior relationship manager, covering second charges, buy-to-let, commercial finance and bridging. Matthew now covers the whole of the south for Pepper Money second charges, which is quite an area. And I think you're based in Cardiff, Matthew, aren't you?
I am. Yeah. So those trips to Norfolk are
horrendous. Been there myself. Yeah, Bournemouth to Norfolk was always my favourite. 7.5 hours was the longest journey, but the story of another day. Okay, his interesting fact. He went on an unusual route to financial services, training in Mount View Academy of Theatre Arts, where he studied musical theatre. After a short stint doing theatre tours, short films, and some feature films, he decided to make second charges his preferred career. Okay, not one I've seen before. Right, okay. Matthew, over to you. I'll see you in about 20 minutes.
Okay, great stuff. Thank you very much. Okay, yeah. So, as Tony mentioned, my name is Matthew, and I'm here from Pepper Money to talk all things second charges. Now, I'm sure you'll know the name Pepper Money very well from the specialist first charge world, but you may not be as familiar with us when it comes to second charges. Now, we already mentioned as well that Pepper Money purchased a company called Optimum Credit. So actually, Optimum Credit have been in the world of seconds for an awful long time. So even though we're new to Pepper Money, we're a long established second charge lender. So let's just click through here. Does it work? Yes, it does. Great stuff. There's always a panic. So for today, then, we're going to go through, have a quick look at the seconds market and the impact of the COVID-19 pandemic. Some of the myths surrounding second charges and maybe some of the reasons why you haven't considered second charges in the past. Look at how second charges are, basically it's something that you really should be considering to your clients, your typical customer, and as well how to access these products. So the second charge market is not as big as the specialist first charge world. Obviously, that is a huge market. We were talking pre-pandemic a 1.3 billion pound market. Now, again, it's not massive in comparison to the first charge world. However, what is really good to see here is that it's been on an upward trend since 2015. Now, obviously, we saw a bit of a dip, a massive dip in 2020 because of the pandemic. But the most promising thing here is that 2021 is almost up to pre-pandemic levels. And actually, with where we've been year to date, I can see us smashing the 2019 figures come the end of this year, providing nothing else happens. Dare I say it? But I'm sure nothing else is going to happen this year for us. So why wouldn't you have considered seconds previously? Well, obviously, as Tony mentioned, I joined the market back in 2007. Some of the myths I think are accurate. A lot of people thought it was a relatively flat market with an awful lot of large fees, lender fees, complicated early repayment charges, poor regulation, and just the assumption that seconds are, extremely expensive, and that the journey was a slow and painful one. Now, I think it's only fair to say that, pre-credit crisis, a lot of these things were the case. Obviously, there wasn't as good regulation. There were, the seconds available were a lot more expensive. But we are talking an awful long time ago now. So a lot of these things have completely changed. So let's go through a couple of things. Now. So right now, the reality is that second charges, it is ultimately a regulated mortgage. So it's aligned to MCOB, MMR, MCD. Ultimately, we're just looking for the best outcome for your clients. If you were to produce or have an ESIS sent across to you for a second charge, and this is across the board now, not just for us with at Pepper, this is any second charge lender, the mortgage ESIS, the mortgage illustrations would be exactly the same as what you would get on a first charge. So it would be nice and easy for you to understand it. It outlines exactly the terms, the interest rates, the reversion rates, and ERCs if they're applicable. Now, fees are significantly reduced as well. So lender fees are in line with that on first charges. And I always use an example. I did a switch on my first charge back in January. Luckily, I did it in January and didn't wait. But I'm with NatWest, and I made a switch on a product with a 995 lender fee on it. Now, our lender fees start at 595 and can go up to 1,500, depending on the product which you select with us. But I think that just goes to show that the lender fees are pretty much in line with that of first charges. Now, we have a wide range of products available to you. So we've got your standard kind of variable rate and your fixed rate. So your 2, 3, 4, and 5-year fixed rates. We also have a discounted rate, which is a 12-month discount, a 2-year discount, a 3, and a 5. And then also we have a little hybrid of an interest-only product. Now that does cap you at 65% loan to value. There is a minimum term of 15 years on that and a maximum loan of 200,000. And the reason I say it's a hybrid is because for the first 5 years it's interest only, and then it switches to a capital repayment after that. And going on to the other point about rates being the rates being high as well. So we've got rates starting. I know it says 2.9 there, but we have had a change since I sent this across to Tony. So our rates now start at 3.2. And the biggest thing on this page is probably the fact that we lend up to 100% loan to value. Everything is digital now. The whole process is a lot slicker. So we've got a portal which everything would be put on there. The dips you can get within minutes. We use automated valuations as well. So very often you don't need to have a valuation with a second charge. And again, this isn't just through us, because yes, I'm here to talk about Pepper, but ultimately I want to just make you aware of the flexibility of the second charge market as a whole. So there's an awful lot of lenders out there that use automated valuations, so home track. We're actually running just under 70% of cases are currently going through without the need for a full valuation. So that just gets you away from those dreaded valuers comments, which nobody likes. And obviously with ourselves, that we lend from 5,000 up to £1 million as well. Now, the other thing to really mention with us and why we stand out from the crowd is that the service. So we can get offers out to your clients. 24-hour offers basically. Now, and I know you're probably used to people talking about, the perfect pack, but if you have, because a lot of the things are automated now with the digital, the EID, the facial recognition, things that we can use with Nevo, the fact that you don't need to have valuation. If you came to us with the first charge with Halifax, for example, now Halifax don't register a restriction on land registry, so it means that you don't have to go and get consent from that first charge. Getting consent can always take a little bit of time. It can take 10 days. It could take an awful lot more sometimes if you're dealing with some of the lenders that I won't mention. Tony, you'll know exactly what I mean. But ultimately, we can get a perfect pack sent up to us in the office on a Monday morning and offer that by the following day. So the fact that seconds are a slow process as well, that's another myth that needs to be consigned to the history books, because nowadays you can get deals out. You can come looking for a second charge on a Monday and have the funds in your account next week. Again, it doesn't always happen like that, because if you do need a full valuation on a property, then you need to look at surveyors' availability. That can always slow things down, and the information that you need from the first charge lender. So my keys aren't working. I need to click. Sorry, guys. So why a second charge? So, okay, as I've just mentioned, you may need to raise capital more quickly. So I've covered that off just now. You don't want to lose your existing rate on the first charge. So that could be that you've got a lifetime tracker. So it could be a GE Money lifetime tracker, or the Cheltenham and Gloucester deals, all those kind of ones that makes you jealous that people have got these deals, but you're probably never going to move them off those because they're just too good. Maybe the first charge is interest only, and switching to a repayment would be obviously more costly. You might not have the term there because of their age, so we can look at a second charge. Now, if you can't obtain a further advance from their existing lender, maybe they're no longer lending, or whatever that case might be, it might be that there's too much consolidation, and that's always two of the most common reasons for a second charge. First would be debt consolidation. Second would be home improvements. Now, you guys will all know that if you've got someone looking for a first charge and there's an awful lot of debt outstanding, that's going to obviously have an impact on whether or not they can get a first charge. But coming to us, rolling all that up into a second charge means that come 2 years, 18 months, 3 years, whatever it is down the line, then you're just going to be rolling that up into one remortgage, and there's going to be no issue in terms of consolidation because it's going to be a secured debt, not unsecured. Now, it could be as well that it may be an unusual loan purpose. So if you're looking to take money out of your property to pay a tax bill, so we've seen an awful lot of those. We always do at the start of the year up till about the April point. We see an awful lot of tax bills. It could be for school fees, or it could be as well for business purposes. Now, ourselves at Pepper, we wouldn't be necessarily interested in a business startup, but if you have an existing business and you're looking to purchase another business, a similar business, or if you're looking to expand premises, purchase new machinery, all these kind of things, providing it's an existing business, and we can entertain those business loans. And then obviously the biggest one, ERCs on the existing mortgage. Obviously you would consider a second charge if there were high ERCs on the first charge. Now, if you are having issues affordability wise, so again, this could be to do with loan to income. So we're a little bit more flexible when it comes to loan to income. So our standard product, our prime offering, which goes up to 100% loan to value, has a cap on of LTI of 6 times, which is a lot higher than that of first charges. But then we also do have a product that doesn't have an LTI cap. So there you're looking at an LTV of 80% maximum, but there you don't have any LTI calculations. So it's all based on affordability. So providing it fits affordability wise, it can be 7, 8, 9 times LTI, and we will do the deal. Now, and then some of the other points there are just around personal loans. Obviously, some of the rates that I've already mentioned will be cheaper of that than credit cards and unsecured loans, or even a bridge. So pop on through to some of the other kind of the other reasons why you might take up a second charge. Now, I mentioned previously the 2 most common ones being debt consolidation and home improvements. Now, I've already mentioned the fact that if it's a debt consolidation and you're having trouble because there's an awful lot of debt outstanding, you're only going to wrap that debt up in a remortgage come 3, 4, 5 years whenever the first charge rate comes up for renewal. But also, if you're looking at high LTV, because another issue is, people are saying, you go up to 100% loan to value, that's a little bit risky, is it not? Well, a lot of the loans we do up at 100% loan to value are for home improvements. So obviously, we're looking at the valuation at day one and going up to 100% of that. But if you're doing a rear extension on the property, you're adding a bedroom upstairs because you're going into the roof space, basically you're going to be increasing the valuation of that property. So don't be concerned about going up to 100% loan to value, because ultimately once that work is completed, that property could be at sub 80% loan to value. So therefore wouldn't cause you such an issue when you come to remortgage it away. Because ultimately a lot of these scenarios are, 5-year fixed rates are getting more and more popular, understandably, because of the interest, the increase in the interest rates of first charges. So these applicants of yours are being locked away for 5 years. Now they're obviously going to still have these needs, whether or not it's for the home improvements, for the consolidation, for gifting money to a family member, or whatever it might be. So these people will still have this need. So if they're not coming to you for a second charge, or you're not considering it, they will be going elsewhere, tapping their things online, looking for a £30,000 loan, and they'll end up with another broker. So it's really important that obviously you're aware of this. And don't forget as well, when you're looking at a second charge, say you've locked someone away for 5 years, you're in year 2, you do them a second charge, then you've also got the further need for to review the life cover as well, to cover because obviously the secured debt would have increased. Now, matrimonial settlement, put my teeth in, that's another common reason that we would look at second charges. And then your kind of obvious ones there, your the tax bills that I've already mentioned. and the business loans. But if you've got applicants that are looking to take money out of their property to gift to a child, that's absolutely fine. We're happy to do that. And as well, if they're looking to take money out for a buy-to-let purchase, maybe they've already got a couple of buy-to-lets in the background, or they're looking to get their first buy-to-let, that's absolutely fine as well. So we can withdraw money for a complete outright purchase or contribution towards a deposit for a buy-to-let mortgage. So, and as well, time in property with ourselves as well. So mentioned down there, ex-local authority properties. This is where Pepper are very good as well. If you do have someone that has recently purchased their ex-local authority property, so say they were renting prior to this, they bought their ex-local property, we actually only need 1 month's mortgage payment to be made. Providing we've got a rental reference that gives us a 6-month history, we can be looking at those properties. And the reason I use an ex-local authority property there is because we ignore the preemption. So the discount that they would have had on their council property, we completely ignore it day one. So we go to our full LTV day one. And here is just an example of the most common customer that we see. And this does kind of put to rest some of the preconceptions that people have about second charges. Again, that they are only for people with poor credit, people on low income, or people on benefit income at high LTV. So as you can see here, an average loan that's actually increased now. So it was 42,000, but we've seen it increase the last couple of months. Our average loan is currently 60,000. A very healthy average household income at 72,500. Good value on a property, 428. And as you can see, our average LTV there is only 65%. So it's not the fact that we're always doing these 95, 100% loan to values. The vast majority of our clients are employed as well with a good credit score. So I think that really does show that that is your perfect client. That would be a perfect person that you could remortgage in 2, 3, 4 years, whatever it is. So you don't need to be concerned whether or not that you'd be able to get them out of the second charge. Now, so obviously, how do you access our products? Well, the best way to access our products are through specialist brokers like the Specialist Hub. And the reason for that is because these guys are specialists in second charges. They have not only ourselves, but every single lender that's on panel available to them, so that you know you are getting the best advice and the best outcome for your client when you go to someone like Specialist Hub. Oops, I've just clicked far too fast. No, I haven't. Sorry, I'm just getting used to this. So here are some scenarios where you would use a second charge, some case studies. I won't kind of go through every single, all the nitty gritty of them. But the first one there is an unclear debt management plan. Now, 10 years ago, after or more now, after the credit crisis of 2008, there was an awful lot of debt management companies that popped up. Debt management was a good route for a lot of people. And a lot of these people still have these debt management plans outstanding. Now, if you have someone that's got a outstanding debt of 40,000 and they're only paying £20 towards that, it's probably not going to be best advice to consolidate that into a secured debt. So we are happy for those debt management plans to remain in place, provided obviously we just get a payment profile for the last 12 months that can stay in place. The scenario there with Mrs. Khan, so 100% a bonus. Again, we're seeing an awful lot of people now on, well, we see it all the time with likes of a car salesperson or a estate agent, you know, some people who are on a relatively low basic but earn an awful lot of commission bonus over time. We have a product available that we will take 100% of additional income. So absolutely all of it. So Mrs. Phillips, who was recently self-employed, and this is a really good thing to talk about in terms of coming out of the pandemic. We've seen an awful lot of people change roles. Maybe people have changed jobs, maybe made redundant, started a new job. We're happy with people who have only been in their job for a month and are within a probationary period. Providing they've stayed within the same industry, we will entertain that. And we've obviously, this would have happened a lot coming out of the pandemic. The same with people going self-employed. A lot of people have thought, hang on a second, I can do this myself. I can work from home. So if you've got people that are recently self-employed, we only need them to be self-employed for 1 year, and then we can look to do a loan for them. Mr. Lee there, that's a high loan to value one, but I've already mentioned the fact that we can go up to 100% loan to value, and very often it's for home improvements as well. Heavy adverse on this particular one. So yes, we are to go up to 100% loan to value. So as I mentioned before, and I wouldn't expect you to remember all these things about our plans, but we've got the two plans. One is our prime offering that goes up to 100% loan to value, and then one is our plus offering that goes up to 80% loan to value. So on the plus offering, we actually can look at any amount of adverse. The key with this is that the client isn't in a downward spiral. So if there is worsening arrears, so accounts going 0, 1, 2, 3, that's going to cause us a bit of concern. But if you've got the odd missed payment on credit cards, maybe a default or two, a CCJ, could have missed a mortgage payment 10 months ago, these are still applicants that we can still consider on a second charge. And then Mr. Smith, great old name, Mr. Smith. So 0-hour contracts or agency work. So here we have, again, this can be as a result of COVID as well. More and more people going into 0 hours contracts, or a day rate contractor or an agency worker through an umbrella company. All of these scenarios, we can look at 100% of the income. And we have that product offering there for on our plus offering for these scenarios. So that's about it, really. I hope I've not sent anyone to sleep. But as you can probably see, there's an awful lot of opportunities when it comes to second charges, and it's a growing market. So if you're not considering seconds for your clients, somebody else will be. So I shall pass you back to Tony.
Matthew, thank you very much. It's always good to. I've been second charges now for 39 years this year, so
wow,
always incredibly interesting to hear somebody who's also been in the industry for quite some time and their take on what the market is like. It still astounds me that people do not consider it as an option, because
absolutely,
we write a hell of a lot of second charges. We really do.
Yeah.
So we've got the questions yet, but we've got a couple of questions already come over. So we've got an excellent question actually from Linda Carvel, which I'll let you answer, but also I'll partly answer as well, because this is pretty unique to the second charge market. Is a solicitor required to register a second charge on land registry, or does your company do this?
Okay, so basically we register the second charges, but that's because we have solicitors in-house that deal with that for us. There's no need for conveyances like there are for first charges, so that side of it is a lot more straightforward, easier, simple and quicker. So we've got Robsol solicitors that they used to be in our office. We call them in-house. They're not exactly in our building anymore, but they're just down the road from us in Cardiff. And we've got a specialist team within their company who deal with all the registrations for us.
And the reason I say it's always been the case in second charge is that the lenders did not want to get solicitors involved, because it's fairly pointless, to be honest with you. And I'd sometimes see remortgages going through, and I do wonder to myself, why on earth is a solicitor involved in this?
Yeah,
it's just such a simple process when somebody already owns a property. All that happens is that you've got a solicitor earning money from something that you really don't need to do, and you've got a client having to pay for something that it shouldn't have to pay for.
No, exactly.
And
then it always takes weeks for them to justify their fee.
Well, exactly. So the longer they can drag it out, of course, the more they can charge, because they charge every 6 minutes they do something. They charge by the hour, and we see stupid fees being paid by clients for something that was totally unnecessary. So hopefully that will answer that. But yeah, all second charge lenders have their own internal legal team who will register the charges on their behalf. No involvement from solicitors at all, which is a major advantage. So the speed, as you can imagine, is just like, if you haven't done a second charge before, you won't believe how quickly they can go through. Colin Brown has asked, what is the oldest age you lend to at the outset and at the end?
Okay, good question. So at outset, there isn't kind of we have a maximum age for our prime offering, which is 70, and then we can entertain up to 80 on plus offering. There are a lot of lenders, obviously, that will go up to higher ages, but ourselves, really, if you're looking at a prime applicant and you're taking employed income day one, the max we're really going to consider is 70. But at day one, if they are retired, so if they're already in their late 60s and retired, we can entertain that then up to 80 or 85, 75 or 80 on referral.
And you'll tend to find, Colin, that most lenders will use the common sense approach. So if we have a 69-year-old bricklayer, self-employed bricklayer, it's unlikely he'll still be laying bricks when he's 80 in the freezing cold of winter. Whereas if you've got a 69-year-old finance broker, for example, who sits in his bum most of the day, it's more likely they would lend to somebody like that whose job isn't a physical thing and just involves them maybe looking at a screen. And as long as they got eyes and fingers and they can type, they should be able to borrow.
A business owner as well is always a good one. A business owner that can continue to take a back
depending
seat.
on what they do. It depends very much on what they do. If it's something that is a physical job that requires, it's a young man's type of game. If it's a builder who employs loads of people, different. He probably does sit on his bum all day, just directing people to do the job that he used to do himself. Nigel has asked, second charges on buy-to-lets.
We don't at Pepper, but there are an awful lot of lenders out there that do offer second charges on buy-to-lets. Yeah,
and especially for those of you that have been writing 5-year fixed buy-to-let products for the past few years, since all the changes came into place, I think it was 2017. Second charges are great for that, and we write a lot of that business where there is a fixed rate in place because, of course, the client doesn't want to pay the high ERC. So there's plenty of products out there at the moment, and plenty more coming to market as well. Okay, I'm very aware of the time. So Bavin has said, if you are a first charge lender, do you do second charge or further advance? If not, you allow second charge through someone else. I'll probably answer that in that when it comes to regulated mortgages, I know of only one lender at the moment who we have a problem with when it comes to obtaining consent to a second charge, which is Kensington. Kensington, if there's arrears or there's been arrears in the last year, they do refuse. But what happened when basically second charges became regulated, we saw a major shift in the attitude of first charge lenders and under treating customers. Is it treating the customer fairly to refuse consent when it puts the customer in a better position? So we are finding now it doesn't really cause us a problem. And there are also lenders as well who do not require the consent of the lender because they've just registered what's called an equitable charge, not a full charge.
Yeah.
So we've got all bases covered on that these days.
That's right. Yeah. And if there is a restriction for us, we always need the consent. And I don't know if that question is asking about Pepper Money. If you've got a Pepper Money first charge and we're doing a Pepper Money second, do we need consent? But the answer to that also is yes, we do, unfortunately. We still need consent from Pepper to lend to Pepper.
And they charge for it probably as well. Okay. And Mike Bill this is the last question. Mike Bill has asked, you've said that if someone takes out a second charge when they come to remortgage, they would then capital raise enough money to clear the second charge. If they do not want to do that, does that cause a problem with the remortgage?
So if we're looking at, and correct me if I'm wrong, that I haven't misread this, but if we're looking at a like-for-like remortgage, so no further borrowing for the first charge, you're just taking them from NatWest to Barclays, then we can enter into a deed of postponement for that, and we will agree that, providing there's no further borrowing. If there was further borrowing on the remortgage, then we wouldn't consent to it. Remember, second charge lenders want to keep customers on the books as long as possible because that's how they earn their money. So they'll do everything they can possibly do. If it is, like Matthew says, straightforward refinance with no capital raise, I've never known a lender to say no unless there's been major problems with the account, but in which case they probably wouldn't be able to remortgage anyway. So, but it's very, very rare, incredibly rare. Absolutely. Right, we've no more questions. I'm not going to ask the ones you asked because you've covered 3 of them. So thank you for those that have asked questions. That's great to see a few, and there's been some excellent questions there. Matthew, thank you very much. Simon will remove you from the room. Okay. And our next speaker is Amanda Lammers from Precise Mortgages. And you should have received this from me this morning or from one of the team. If, by the way, there's been quite a few of you signed up after 10 o'clock, and obviously I've not been able to send anything out because I've been sitting here doing the presentation. So if you haven't received any of the documentation, or also you haven't been able to request any of the documents that we give away, I'll probably send those to you as a matter of course, just in case they are of use to you.
So, but you should have received this. So please refer to this. If you haven't printed it off, then maybe a good idea to do so. A little bit on Amanda. She's worked as a BDM in London for over 6 years, starting her career at the Coventry Building Society before transitioning to what brokers call the dark side, which is specialist lending. Before that, Amanda was a broker and so is familiar with some of the pain points of various lenders. Her favourite thing to do is travel, which is why she has no pets. Amanda has also realised after her latest visit to Cornwall that she is not much for the countryside and prefers a good stroll through the city. And Amanda is actually currently in the room, but is sideways. Now, I don't think that's she's going to be presenting.
Right. Let me change this round.
That's the one.
We did have a practice run as well yesterday. And
yes, I heard.
Let's have a look.
So
there we go. That's better, isn't it?
Perfect. Okay, so we can hear and see, which is great, and you're the right way up as well. So at least you weren't hanging upside. We've never had anyone do one upside down. So
this is an iPad, you see. Yeah, great.
Okay, right, and this is one I've not come across before, and I need to ask more. Amanda's interesting fact is that she once had an American accent. Please explain.
Well, I was originally American. Well, I am American, I guess, but when I moved to the UK, I was probably the quickest American in history to lose their accent.
Right,
Probably
okay.
about a year or two. I don't know. It just went. My brother actually still has a slight American accent, and we sound completely different. So it's quite interesting. But yeah, I've been here for a number of years now. So
excellent. Okay, someone's just said that I think maybe it's taken a while to come through, that you're sideways on the screen. You're the right way up on my screen. So hopefully, and someone else is typing, but if Amanda needs to turn the camera around.
Can you?
That's the one. There you go. Perfect.
Because when we did our practice run yesterday, because my iPad's clicked into the sort of keyboard thing, and he said that I was the wrong way around, and I thought, oh, that's weird, because this is how the iPad sort of slots in, so onto the keyboard. So we're looking good now. Yeah, that's good.
I believe so. Someone's just said that you are up. You are now upside down.
How is that possible?
So you're the right way up on mine, but upside down on others. So, and some of I think what we'll do, if we just otherwise, I think if you turn it the other way, you'll be upside down for some and the right way for others. So don't worry about it. For those that are seeing Amanda upside down, this will be the only time you'll ever see an upside down presentation from somebody online.
Well, actually, the majority of people are saying it's all good now.
It's all good. Don't worry about it.
Sorry if you.
Don't worry. Right, over to you. I'll see you in about 20 minutes.
Lovely. Thanks for that, Tony. So hello, everybody. My name is Amanda. I am the Business Development Manager for Precise Mortgages and Kent Reliance as of about 3 weeks ago. For the purpose of the presentation today, I'm just going to be going through some of Precise criteria as we've got 20 minutes today. So one of the next sort of webinars that I'll do, I'll sort of cover off more of the complex Kent Reliance side of the business. So some of you may or may not know this, but back end of 2019, Precise merged with the One Savings Bank group. So within that group, you've got Precise, you've got Kent Reliance, as I mentioned, and you've also got Interbay, who is kind of semi-commercial lending within the group. Obviously, we're all specialists within all specialist lenders within the specialist market, and we should be able to help your clients with the majority of kind of specialist complex lending. So going to cover off just a few key points, and at the end, if you've got any questions, you can sort of fire away. So what does specialist lending look like? Many of you will be sort of quite au fait with the specialist arena, I'm sure. These are just a few areas that we can help your clients with. Bridging, so Precise can do your kind of more light bridging. You've got Interbay that have actually come back into the heavy refurbishment bridging side. Help to Buy, Adverse is a big one, and again, this is across the group. Whether your clients are self-employed and they might have some kind of a little bit more sort of complex income, and obviously COVID's been a major factor for some of these clients getting the lending that they need. So as I said, I'm going to cover off a few of these sort of key areas with you as we go through. So I'm going to talk about residential first of all. Now, residential for both Kent Reliance and Precise is a smaller part of what we do. So probably about 20% of our lending is self-employed. The majority is kind of your more complex buy-to-let stuff. But it's important just to kind of cover off some of the key points, because we, as I said, we although we do only 20% of our lending for residential, as I said, we are a specialist lenders, and there's a number of key points that I'm worth covering off with you. So areas that we do really focus on is helping self-employed applicants. So as I said, I'm going to kind of be going through Precise criteria today, but some of this is actually applicable to Kent as well. So we can both work off their latest year's trading figures, so regardless of the jump. So that's a really, really good one actually to remember, because you've got to see your high street lenders who will say we'll work off latest year, but generally it's just not in their risk appetite to have these kind of really large increases. So obviously with those kind of deals, the bank statement should reflect that higher income, and we would expect that. Obviously we'll want to see bank statements, savings, etc. 1 year's accounts we can also consider. So this is kind of bread and butter for Precise. We can do that sort of stuff all day long, and we're not really too concerned what they were doing previously. With Kent, they do want to see 2 years of trading, but generally if it's like you say they're employed and then they went self-employed and it's the same line of work, they tend to be quite flexible. So 1 year's trading with Precise, latest year's trading figures, and one of their key USPs is the fact that they can also take an average of a declining profit. So you might have good clients that invested in, maybe bought a van, or they might have been on maternity leave and their income's gone down. We can certainly take a view on those kind of deals as well. Now, we do work off salary and dividends for your limited company directors. Can consider working off the share of net profit or retained profits for your limited company directors as an exception. Adverse is another really good one worth covering off. Precise are kind of more the adverse lender within the group, because we have a really great system. We've got 5 tiers of products. Once you do an AIP with us, as those of you that might already use this in the past, you'll find that the system will cascade for you. So we can support clients for a number of different adverse reasons. So we don't count missed payments on unsecured debts, which is a really good one. As I said, we do have a cascading system. So if they've got a lot of recent adverse, or like worst status 6 on a credit card that's sort of in the last 7 months, it might be that we don't offer them our top tier product, but we certainly will lend to them. Default CCJs, only look at the registration date. So if it's registered over 2 years ago, not too concerned. That's a really good one. Missed mortgage payments as well. We've got parameters for that, up to worst status 3 and 3 years across all secured debt. No debt to income ratio, and that applies across the group as well with Kent Reliance. So as I said, it's a bit more sort of out of the box thinking with us. Capital raising, can do it for any legal purpose, and again that's across the group. So debt con, paying off even a director's loan for business purposes, we can consider those kind of deals as well. Tax bills potentially. So, if they've got tax arrears, maybe less likely, but if they've got, decent liquidity in the business and it's a recent tax bill, we can certainly consider those kind of deals. Interest only. So that's just a good one to cover off with you as well. So you will find with the majority of high street lenders that look at interest only will kind of base the affordability as though it's still a repayment mortgage, whereas that's where we're, come in handy, Kent and Precise. We can work off an interest-only affordability rather than having to fit on repayment. So if you do our calculator, you'll find that you'll get a different affordability calculation if you switch from interest-only. So max 65% loan to value if it's pure interest-only, or we do allow part and part, so 50% interest-only with a 25% additional on repayment. So the key points there really to take away from this, certainly your self-employed clients, we've got loads of criteria that can support them across both brands, and particularly adverse as well. So coming on to buy to let. So I should have started by saying really the difference between Kent and Precise. I mean, one, you're going to get the flexibility with Kent Reliance that you won't get with Precise. We are quite black and white, but also our rates are cheaper than Kent. So if brokers ever come to me for a deal, I would normally guide them down the Precise route first, and if it didn't fit, then we would discuss Kent Reliance. So in terms of buy-to-let, you would probably come to Precise for your first port of call for the rate. Although Kent Reliance are the lender that cater for your more sort of complex deals. So Precise can lend up to on properties or HMOs up to 6 beds, or we can do multi-unit blocks as well, up to 6 units on one freehold. Kent Reliance will then pick up the biggest stuff between 7 and 10, and then you've got Interbay to pick up the even larger stuff. In terms of HMOs, as long as we can see it's been applied for in terms of the license before completion, we are fine with that. Limited company lending, massive part of what we do. We like kind of a bit more of a less complex SPV setup at Precise. So we're allowed to 4 directors and shareholders on the SPV, which has to mirror the application. Now, Kent Reliance, they're not really bothered about shareholders, just the directors that go onto the application. So those are the big things to remember. Intercompany loans as deposits is pretty standard for us both. So if your client's got a trading business, rather than drawing the money out of the business and being taxed on it, best way to do this, the most tax efficient way, is just to do an intercompany loan from the trading business to the SPV to form the deposit. So age, we can do a 35-year term for an 80-year-old. So we're very flexible. So it's effectively taking the term over the client's 100th birthday at Precise. So it's a good one to remember. Now, first-time buyer, first-time landlords, I haven't had an updated presentation. We actually stopped doing that as of about 2.5 weeks ago at Precise. So fortunately, it's not an area that we support with at the moment. If you've got an applicant who is a first-time buyer on the application and someone who isn't, that is acceptable, and we would assess that on our normal kind of buy-to-let rules. Non-owner occupiers, obviously fine with us, don't mind clients renting. Just they must have owned a property in the last 18 months to not be classed as a first-time buyer. Adverse on buy-to-lets we can support with as well. We are not doing the kind of heavy adverse that we're doing on residential, so we've only got 2 tiers of products. Oh, what happened there? 2 tiers of products, I had a noise there. 2 tiers of products. We will allow a little bit of unsecured arrears at Precise, but missed mortgage payments in the last 3 years or defaults in the last 2 years is unacceptable to us at the moment. So we're running out of time here, but just wanted to cover off at the end our bridge to let product, or refurbishment buy to let. And some of you might have heard of this before. There are a couple of other lenders in the market offering a sort of similar proposition. The purpose of this product is to allow your client to buy a property that's not quite habitable, put it onto a short-term bridge, and then refinance it onto a buy-to-let within 6 months. So it's all kind of under one wrapper though. And the benefit of this product is that it gives the clients the assurity of an exit, which you always get with a bridge. I think that's the worry for some brokers, with bridging, which is why many of them will just sort of send it off to packages. But it's just to kind of give you a few key points here. You submit the application. We would pop the property onto a 6-month bridge maximum. So say they bought a property auction and it needs a little bit of work. It is a light refurb product. So within that, it would probably be new kitchen, new bathroom, liquor paint, that sort of thing. Don't like sort of change of use, any sort of big jobs. So really, it shouldn't really take them any longer than about 3 months to do this works. So you submit the application, we'll review it. You also will need to give us a schedule of works. The schedule of works will be what the value will base the buy-to-let value on, because it's going to give a value for the bridge and a value for the buy-to-let. It's one underwriter, one process. We then will give you 2 offers based on both the values. So say they come back to us, they've done the works within sort of 2 months, let's say. We will then send the valuer back out to do a re-inspection on the property. And if he's all happy with it, then we just pop it onto the buy-to-let element of the product. So it's significantly cheaper than your standard bridging. You're probably paying about 0.75% as opposed to 2% on the arrangement fee. But again, it's only for your light refurb jobs. It might be that your client's inherited little old granny's property or something like that. Again, where it just needs a little bit of work's doing to it. So great. So that's my 20 minutes actually exactly. So let's go through any questions that anyone has. So we've got a few questions at the bottom here actually, don't we, on the chat? I don't know if are you going to go through that, Tony?
Sorry, Amanda. Yeah, I was trying to get it. I was clicking the button, it wouldn't come on. So
no problem.
We've got 3 questions for you. Thank you for that. And by the way, I've just been next door to where my IT team are monitoring. You are upside down next door.
Oh, am I?
But you're the right way up in here. So I did say we are relying on outsourced technology. But that's a unique one for me. Someone's actually done a presentation upside down. So anyway, we got Laura's asked a question. Laura Lyons has asked, are you doing right to buys?
We are, again, actually, as of about 2.5 weeks ago. So it's a really good news because, you know, we used to get quite a lot of questions around right to buy where clients have got small blips on their credit reports and things where we couldn't offer them any deals. Whereas now, we're back in the game again. So no problems there.
Okay. Fernando Gattino's asked, but you've already answered this about first-time buyers for buy-to-let purchase. That's already answered, so I won't cover that. Linda Carvel has asked, do you have a minimum income requirement for your interest only?
So there isn't anything specific around interest only, but we do have a minimum income of 15 grand, which is nothing, isn't it? You know, if they're most likely going to meet that, particularly if they're kind of in the southeast. So yeah, just 15 grand, which is all of our kind of residential deal requirements on income.
Okay. And Linda's obviously going for the asking most questions of the day prize today. So thank you, Linda. Do you offer free valuation or free in-house legals for prime remortgage clients?
We don't, unfortunately. We do have products at Precise that have no fees, which is great to see. The no arrangement fees, refund of valuation on completion up to a maximum of £630. So it's not necessarily a free valuation, but yes, we would be happy to refund that once the mortgage completes. And then legals, unfortunately, they do need to pay legal fees as well with us, unless it's a PC.
Okay, someone is typing, but you also set yourself a question. Do you lend above commercial?
So yes, we do lend above commercial. Precise and Ken also do. It's I'll be honest, as I said, we are very flexible around policy, particularly with Kent, but lending above chicken shops and things like that, it's not really our bag actually, and that's really across the group. So is it anything noisy, is it smelly, that's kind of thing we tend to sort of steer away from. Pubs are a big no generally with us, but yes, we can lend above commercial.
Is that a situation as well? Is it just above, or if it's next door? Or we've had lenders turn down cases before because there's been a pub 5 doors away, for example. Is it down to valuers' comments, or is it, because that can vary between one valuer and another? So how do you? And
the problem with this, Tony, is it varies from valuer to valuer as well, because it kind of it's whether they feel that is going to affect future saleability. So if you've got a massive Wetherspoons, 3 doors down, it is very likely that it will affect it because it is open sort of late. If they've got tables and chairs outside as well, you're gonna have people hanging around late at night. But we have lent where there's just maybe a small cafe that's kind of maybe not directly below but next door. We can consider that sort of thing. But pubs just generally, even when they're directly across the road, would tend to be a no-no. So if a broker sends me details for a property, I would normally sort of have a look on Google, but look not just what's directly below or just directly next door, but maybe look across the road and a few doors down.
Okay, we've got 2 more. I would do 2 more questions. Mike Bill has asked, do you have a maximum age application?
We don't actually. No, we don't. Although saying that, I suppose we do have a minimum term of 5 years. So I guess there is technically, I suppose, although there isn't anything in policy, with Precise, if it's a residential deal, we'll lend up to 70 on a kind of no questions asked around pension, or 75 of pension income. So I suppose you're really looking at getting in the application in before the client's 70, and then the same with buy-to-lets. So 5-year term.
Okay, and final, someone is typing, but this could be the final question. Mike Hurd, hi Mike, hope you're well. What is the criteria for being near pylons or substations?
Don't like them. I actually had one to climb very recently. I'll be honest, Michael, not good news. To be honest, it's there again with this kind of thing. There isn't actually anything in policy, but it's down to the valuer actually didn't like that because he did feel that would affect future saleability. It was kind of with this one, it was kind of running over the client's garden. But anything near like that, is a bit of a no generally with us. This
is why, as a broker, we love AVMs.
Yes,
cutting out the surveyors, and another leech on the finance industry. Unfortunately, our surveyors. Really... Right, I think we've got all the question. Yeah, that's all the question. Amanda, thank you very much indeed. Glad to see you the right way up, and also I was listening for any hint of the American accent and didn't hear anything at all. So quite amazed. I was expecting a yaw or something like that to come out. Whereabouts in America was it?
Nebraska. So actually, it's very.
I wouldn't have a clue what Nebraskan accent's like. Just about do a Texan accent. But anyway, thank you very much. Simon will remove you from the room carefully because you're upside down on his screen. So, and we will see you soon.
Thank you. Thanks for your time, guys. Appreciate it. Thanks, Tony. Take care.
Thank you.
Bye.
To our last presentation, and this is today's sponsor. And we welcome Charlie Attridge now I've not seen Charlie in a while, and I've been told he might have a slightly different haircut to the one that's in that picture, but we will see. So first of all, you should have received this from us this morning, which is the Hampshire Trust Bank product guide, specialist mortgage product guide. Well worth a read. We were one of the very first brokers to be approached by Hampshire Trust when they launched all the way back in 2000. The specialist product launched in 2016, and we've been, I believe, their largest broker on 3 out of the 3 of those years since. So we've had a couple of awards from them. Yes, there you go. Very different haircut from Charlie. Can you hear us, Charlie?
Hello. Yes, I can hear you.
Yeah. Good. We can hear and see you. That's perfect. Okay.
Good. Fantastic.
Okay. Right. So, a little bit about Charlie, first of all. Started in the mortgage industry 6 years ago in an admin role for another bank, and has since worked his way up with a lot of hard work and dedication. Started at Hampshire Trust Bank 3 years ago as an internal lending manager. This has helped him gain experience and knowledge of their policy and a great working relationship with his internal team. Since starting his BDM role at the start of lockdown, Charlie prides himself on delivering amazing customer service and has built up excellent relationships with brokers that he works with very closely. And his interesting fact, which I can identify with coming from a family of plumbers, is that, believe it or not, prior to working in the industry, Charlie used to be a trainee plumber, working very closely with a lot of landlords on refurbishment projects. And if it wasn't for how itchy insulation used to make you in the 70s and 80s, I probably would be a plumber as well now, because so my dad and my brother were in plumbing, and the company was actually called SW Sutton and Sons.
Oh, no way.
Yeah, so it then had to be changed to Sun because I refused to go into it because I was always stuck in the loft, lagging the lofts.
Yeah, it's not nice working in a loft, is it? Especially in the summer.
Absolutely horrible. So yeah, I'm glad I didn't go into that. So yeah, I went into finance instead. Some would say that was a great move. Some would say not. So.
It depends on who you ask, doesn't it? It depends on who you ask.
There's a load of people shaking their heads, like virtually shaking their heads at the moment, saying, "Wish you on the plan." Right, Charlie, over to you. See you in about 20 minutes.
Perfect. Thank you very much. So yeah, today obviously just to discuss to you about HDB and what we do. As Tony has probably mentioned, I'm going to be putting a bit more of a key focus on our semi-commercial products, but I will sort of run through some of the basics around what we do on the specialist buy-to-let side as well. So one of the key things for ourselves is our criteria. So funnily enough, I was out yesterday with one of our other BDMs who works on development finance, and you know, when you've got 2 books that we look at, you've got a policy and we've got guidelines. Now our policy book is, let's say, 30 pages long. It's like this, but our guidelines are about 100 pages because we work in very grey areas. We want to make things work, so it's, you know, trying to find mitigants to cases that, you know, may not necessarily fit with one lender because it, you know, maybe it's a tick box and there's just one tiny little thing that's knocking it out. But, you know, with ourselves, we can look at that and go, well, you know, there's something else within this that, you know, we can look at and make it work and understand the client and understand the case and feel like we, you know, can structure something the best way that we can then put it across that it works and you know, gets through to completing. And as Tony mentioned, you know, especially myself and all of the team at HTB, we do really try and pride ourselves on our service, whether that be, you know, relationships, getting things through, and just being approachable. To be honest, we want brokers and anybody to feel comfortable to come to us if they have any issues, if things are going great or if things are going badly, or maybe they've got a really difficult case that they're just struggling with, and, you know, kind of come to us with a bit of, you know, how can you look at this, how can we make this work and make it acceptable to HTB. So some of the basics of what we do. So we can lend to clients up to £15 million. All of our loans, whether it be bridging, semi-commercial, residential term, all that sort of stuff. Our minimum loan size is 100,000, but we do not have any minimum property value. So if you have portfolios, especially, you know, up north, you know, where you've got properties that are worth maybe £40,000–50,000 each, we can look to take them all into one block and lend on that as like a portfolio. So, you know, 4 £50,000 properties we can look at as a portfolio and still, you know, consider up to 75% of that. We have no maximum age, so we do ask when clients get to the age of sort of 80 during their term, we just need to understand a succession plan and, you know, what is going to be happening there. Is it going to be inherited? Is there a plan to sell it off in a couple of years? What is their sort of plan in doing that? And we can, you know, amend our terms and lend in accordingly and towards that to ensure that, you know, they're getting the best possible product for them. We don't have a minimum income. There are a couple of products that we offer, which we do have a minimum income threshold on, which is only 25,000, and that's just for first-time landlords and holiday let properties. Everything else, there is no fixed minimum income. We do want to see that clients have a steady income in the background or something to essentially ensure that, you know, if there are ever any void periods during their mortgage, that they can obviously still afford to maintain their interest payments to ourselves. We don't want to put people in difficult scenarios where, you know, if it was to go vacant, they're going to struggle to pay that. And then we offer 2-year fixed rates and 5-year fixed rates. And then we've got a couple of specialist products as well, which I'll speak about a little bit later on. So the types of clients that we can look to lend to is a very broad range, and in all honesty, it's the majority of people. So trusts and offshore companies, one of the biggest things we do, we lend to a lot of trusts, a lot of companies that are sort of based in Guernsey, BVI, Isle of Man. I've been coming across quite a lot recently. We just ask that in those sorts of scenarios that our borrowers are UK nationals and ideally living in the UK. New SPVs and standard personal name applications, as standard as probably most lenders do. Trading limited companies, so we're not too stuck on the SIC code of what's, you know, what we're coming across. It could be maybe a convenience store, like an off license that it's trading as, that's now just looking to purchase the block that they're currently in. Something like that would be absolutely fine for us to consider. Expats and foreign nationals, that this is probably one of the biggest things that we do, because we have so many countries that we can look to consider outside of the UK, whether they are, you know, Hong Kong nationals living in Hong Kong as an example, Nigerian nationals we've lent to living in over in Nigeria, Zimbabwe, Dubai, all of those sorts of countries are fine for us to consider. We just have a risk profile that we work off of, and generally the higher the risk that we're looking at, it can just be dependent on, you know, how much documentation we may need to see in regards to their source of funds and source of wealth and things like that. And then first-time landlords. So as I mentioned previously about the minimum income, we do ask that they have a minimum income of 25,000 and that they are owner-occupiers prior to their purchase of a buy-to-let. We're not keen on lending to first-time buyers unless, as I mentioned earlier about that flexibility point, if you've got a client who's not an owner-occupier, but they are looking to purchase their first property, well, let's have a look at their income. Is their income sort of a high 5-figure salary? Maybe they're living in a 3-bed semi-detached house in London that's rented, but they're wanting to purchase a few buy-to-lets in Liverpool. Well, the risk there of them moving into it is so minimal, it's just not going to happen. So those sorts of things we can still look at, and that's where I kind of talk about the flexibility of the kind of things that we can do. With our expats and foreign nationals, so they don't need permanent rights to reside in the UK. As I mentioned earlier, they can be based abroad. Again, if they're first-time investors, we do like to see that they are more high net worth when they're based abroad. And we do ask that ideally they do own their own home in their country of residence, but it's not always a deal breaker. Again, it comes down to, well, what level of income are they earning? How can we mitigate that risk that they're not owning their own home? We do like to see that they have some form of UK footprint prior to formal offer. Now, that doesn't necessarily need to be like a mortgage or a credit card or anything like that. We are happy with them just opening up a current account in the UK, but we do want to see that's with more of a traditional lender like Barclays, HSBC, Lloyds, those ones that you can walk down the high street and you can see those banks. And the reason for that is we just want to see that the client's gone through the due diligence of another reputable UK bank. Just minimises our risk kind of even more, especially when we're lending to these, really high risk countries who the clients have nothing over here. Just gives us that little bit more comfort that somebody else has done that. I'm just gonna run through that one. So types of properties that we can consider. So this is just the specialist buy-to-let stuff, and as I say, I'm not going to spend tons of time here as I'd like to focus a bit more on our semi-commercial. So holiday lets we can consider. We ideally look to use holiday let income, but we do ask that they are experienced landlords. And we just kind of look on, well, where is this holiday let based? Has it been running previously? Doesn't necessarily need to have been, but if it's in a holiday let destination like Cornwall, the Norfolk coast, Lake District, places like that, that's going to let all day, then we generally don't have a problem with using that holiday let income. But in a worst case scenario, if it was in somewhere like Grimsby or Hull, we can still allow it to be a holiday let. Not that those are places that many people go on holiday to, but we are more than happy to consider those. We will just lend off of the AST income. New build flats, probably one of the most common things that we see for foreign national investors. HMOs, we don't have any restrictions on the amount of rooms. For HMOs, I have a 43-bed HMO going through at the moment for one of my brokers, which we are doing at 75%. So, really, really kind of good LTVs on those sorts of things as well. And freehold blocks is the same, no restrictions there on the amount of units inside. It's just normally that when we're getting above 4 units, we do generally need to look at that aggregate / block value and determine which one we're going to be lending off of. Serviced accommodation kind of fits in the same sort of thing as holiday lets, but we would generally just use the AST income for serviced accommodation. Student accommodation, we're absolutely fine with students residing in properties or if it's purpose built, but when there are restrictions on the title stating it can only be let to students, it's not generally something that we have much appetite for. DSS tenants, so we're not comfortable in lending to vulnerable tenants, unfortunately, but when it's maybe let to the local council and there are just standard DSS tenants in the security, that's absolutely fine. Now, these two come kind of part and part with the sitting tenants and the low rental yielding. So sitting tenants, regulated tenancies, those sorts of things we can consider. We do ask that in those sorts of scenarios, in the agreement with that tenant, there's no transfer rights. And we would only use the income, essentially that passing rental or the lower of the market rent and the passing rent to go on our ICR. Now, 9 times out of 10, when you've got a sitting tenant, that rental is very low, which is why I say it feeds in quite well to the low rental yielding properties that we can offer top slicing on. clients have some UK income in the background, then we can, you know, look to use a portion of that income to help raise some extra funds. So this is one of our sort of specialist products that we offer. Now we offer this over our whole range on, you know, buy-to-let, semi-commercial, and it's just our standard rates as well. So it's a refurb in term, is what it says on the box, really. We allow for light refurbishment, anything up to PD or planning building regs that can just be done straight into a term loan. We just ask that the valuer confirms that the property is currently habitable, has a maximum relet period of 3 months, and they need to be able to prove to us that they can service the interest for the first 3 months. And as I say, it's all of our standard rates. And as I say, it can be done on semi-commercial, it can be done on residential as well. It's perfect for those people who maybe have, you know, they're purchasing a property, maybe an elderly couple's been living in there for the past 50 years, it hasn't really had any work done to it, just needs some, you know, maybe new electrics, bathrooms, kitchens, that sort of thing. And it's something that we are more than happy to kind of consider just putting straight into a term loan when, you know, there's probably a lot of people who don't want to do, you know, put them on bridges just because of the cost. The semi-commercial. So with our semi-commercial product, we do require that at least 50% of the value is within the residential element. Now, as long as that is the case, you know, it can be more, but it cannot be less than that. So and that's recently changed. It used to be 60-40, which wasn't the most attractive, and it was also quite nerve-wracking as well when you go to get a valuation. It's like, oh, is this going to meet, is it not? But that 50-50 split has really helped, and it's allowed us to kind of keep our rates the same as well, which is fantastic. We consider a lot of different tenant types for semi-commercial, and I do. The next slide does kind of go through a lot of those tenant types, and there's a couple on there that I'll add as well. Again, up to 75% LTV. You know, they can add their 2% arrangement fee to that, and again, that's the same for all of our loans. And our rates for semi-commercial range from about 4.8, I think it's up to about 5.6 across the sort of varied different products that we offer. So your 2-year fixed at 65% is 4.8, but then a 5-year fixed at 75% is 5.2. For loans above 200,000, our rates are a little bit more expensive, between 100 and 200,000. So types of securities, types of tenants that we can consider in the semi-commercials, it's pretty much most things, to be honest. So offices, shops, restaurants, takeaways, beauty salons, hairdressers, kind of surgeries, funeral parlours. Another thing to add on here as well is pubs can actually be included in this, as well as some bars. That's a kind of a bit of a touchy one. We kind of just have a look at that tenant, have a little bit of a Google on, you know, who they are, how do they operate. Is it like a restaurant that turns into a bar in the evening? Maybe in the week it closes at 11 o'clock, maybe 12. But a week, you know, on a Friday and Saturday night, it's closing at sort of 1 a.m. Something like that we may still look to consider. Same sort of thing as what a pub would be, but when you've got the more clubby bars that are open till sort of 1 a.m. in the week and 3 a.m. of weekends, that's something that we would generally sort of steer away from. And the only reason for that really is just the demand in the areas. I have had one which we have lent on. It was, you know, very direct access to London. It was in a town where there was, you know, a very big university, a very big student life, which means that, you know, the flats that are above it were going to let all day long to a student. I know when I was, you know, back in the day, I'd have loved to live in something like that, in all honesty, being able to go downstairs and, you know, party all night and just walk upstairs to go to bed would have been perfect. But obviously that's a very small niche of people that are probably going to want that. But yeah, that's pretty much it in terms of, you know, the kind of people that, you know, we'll allow as a tenancy for, as I mentioned earlier, about trading businesses as well. So we get quite a lot of maybe like restaurants, hairdressers and takeaways. Maybe they've been renting for the past, I don't know, 2 years in the building. They've just been given the opportunity to buy the freehold. Maybe they've got some experience in the background in buy-to-lets, and we're more than happy to consider things like that. We can look at that company's accounts, ensure that they are profitable, they can afford their rent. So if they have been paying rent, we can kind of add that back into their accounts and their profits to accommodate for us using that commercial rental there. We do ideally like to see the majority of rental coming from the residential, but we do have some, we do use commercial rentals still. We just kind of look at the tenants and say, well, how strong are they? What is the likelihood of them not being able to pay rent? How long have they been there? What is the company? And we can go through things like that. So here I've just got a little case study of a semi-commercial that we done a little while back. So it was a block of 6 flats with 3 ground floor shops in there. All of the flats were let on standard ASTs, and all the shops had leases on them. We wasn't too sure about what terms were left on the leases, but I think the majority of the rental that we needed still come from the residential. So the need to use that commercial rental just sort of dripped down. We weren't too concerned about it. We just need to ensure that in those sorts of circumstances, there's nothing in those leases that are going to be onerous to HTB if we ever had to repossess. And as you can see, this client was very experienced. It was quite a nice LTV on it, and we did this at 70. Well, I think it was about 73% on a rate of 5.2 on a 30-year interest-only term. So as another thing that we do is bridging. So on our bridging, it is kind of quite basic, but one thing I will mention about our semi-commercial bridging is providing it meets that 50-50 split, we offer the exact same rates as what we would do on our standard residential bridging. So our residential investment bridging has the same rates as our semi-commercial, providing it meets that split. So they range from 0.55% per month, and we can go up to 75% gross, offering up to 12 months roll up and servicing as well, if that's something they want to do. So this is just a bit of a recap, and one of the products I realized actually wasn't even here is we offer a product called a 5-2 product, which is a 5-year fixed with a 2-year ERC. It comes on, again, all of our range, a little bit more expensive, but obviously you have that flexibility there. We find it very popular for people going on development exits, so developers who they want to retain their property for a little while. They want to get some, they want to get it rented, which is, if you're selling a property which is fully occupied and has been running for 2 years, the value of that compared to the value of a vacant security can be quite different. It can be quite substantial. So, they go on this for 2 years. After the 2 years, they have no exit fee. If they decide they want to retain it, well, they still have a fixed rate for another 3 years on top of that, but they can leave at any point they would like. So as I say, this page is just sort of a bit of a recap from when I spoke at the beginning. But yeah, that's pretty much it. So yeah, open to any questions that you may have.
Charlie, thank you very much. Excellent presentation. Really enjoyed that.
Thanks, Tony.
Fernando Gattino has asked, he's actually got a case here. So UK portfolio SPV landlord looking to purchase more property, but has an offshore holding company in Malaysia. Advised by accountant, would you lend on unencumbered London property receiving good rental?
So the holding company in Malaysia, is that the kind of 100% shareholder of the UK SPV? If that's the case, that's fine. That can potentially be okay. So we just kind of follow it down to who that ultimate beneficial owner is and where they're based and what they're doing. But if we're lending directly to the UK SPV, then that's absolutely fine. I have a really complex one at the moment where it's a UK SPV, which is owned by, I think it was like a Guernsey company, which is then owned by an Isle of Man trust, and the guy is based in the UK. But so that is something we're doing. So hopefully that, if it's the same owner, as long as we're lending to that SPV, then that could potentially be something we could consider.
So Fernando, you know where we are. Chuck that one over to us, and we'll see what can be done for you.
I think
we'll be in
all
touch with Charlie this afternoon.
All I would say is if you can send over to Tony or your contact specialist just a structure chart of how that SPV is owned, following it through, so, to the Malaysia company, the owner at the bottom, just so we can understand exactly, the route that it's going through.
Okay, and even if it's one that HTB can't do, which I don't expect it will be, well, I expect it will be one they can do. We do have an outlet for that, so another lender for that anyway. But hopefully that one we can place with HTB. Fernando, hopefully speak to you this afternoon. There's one person typing, but I'll just ask some of the questions you set yourself. Can you consider first-time landlords for semi-commercial?
So yes, there's not too many lenders out there that do, but we can consider semi-commercial properties for first-time landlords. One of the things that we do ask is that, again, they must be owner-occupiers and have that minimum income of 25,000. They also do need to have good credit, but we can't look at more than 4 units. So, for example, you've got your commercial unit on the ground floor and maybe 3 flats above. That would be absolutely fine. But anything more than that, we would have to start looking at policy exceptions and mitigating that risk of, okay, well, what is their income? Have they owned buy-to-lets previously? What is their profession? Are they an estate agent who's been running it for many, many years? Those are the sorts of things we can look at in those circumstances.
Okay, Andrew Wall was asked, do you lend to a UK family trust where assets left in trust as part of the will and need to pay an inheritance tax bill?
Potentially, yes. I have come across a couple of these before. I think it's essentially, it kind of depends on the experience in the background and how long it's been in the trust and who we're dealing with as a part of that trust. It's a difficult one to just answer straight off the bat because these sorts of circumstances can be very, very different, but it is a potential.
Okay.
What kind of need to understand a lot more information on it, if that that makes sense.
Okay. Again, Andrew, if it's something you want to run past us, then just give us a call this afternoon, and we can speak to Charlie, and just need an idea of what's behind it more than anything else. What else have we got here? What's your view if the commercial is vacant? So you lend on the semi-commercial property, and the commercial element is vacant.
Yeah, so again, we've got quite a few of these at the moment. So we don't really, it all depends on kind of how long it's been vacant for. If it's, been vacant for maybe a year, it's just not had anything on it, then what we can do is we can still lend, we're still more than happy to consider, we can still even include the commercial value there. We just won't attribute any commercial rental to it, and we'll just work solely off the residential income. However, maybe I have one at the moment where the commercial's been vacant for maybe 8 years. In those circumstances, we're still not needing to use that commercial income, but we have said, look, I think we do want to see that there is something in place or a bit of guidance as to the kind of tenant that's going in there. But, if it's just a sort of short period of time, then we're absolutely fine with it. We just more so focus on the residential elements and lend off of those. Okay.
And final one we've got, how much of the commercial rent do you use for your ICR calculation?
So this has actually recently changed. So it used to be that if it was, so when it met the 60-40 split, we wanted to see that at least 100% of our coverage, so we need to get to 125, we needed to see that at least 100% came from the residential and the rest could be made up from commercial. However, since we moved down to our 50-50 split, that's changed, and we can now use all of it. We're more than happy to use all of the commercial rental, but again, we do just like to look into who that commercial tenant is a little bit. How strong are they? Have they been there for a long time? Do they have a long time left on their lease? Something like that would be absolutely perfect, regardless of what the tenant type was. But let's say, on the other hand, you had a hairdressers, which is a new startup business. They're they've just gone in there. They're 2 months into a 3-month rent-free period, so they're not paying rent at the moment. They will be in the next month. When it's something like that, we're probably a little bit more conscious, but we would still be happy to consider using the commercial rent as long as we can get comfortable around the strength of that tenant and also the strength of our client. You know, if you've got that, for example, for a first-time landlord, it's going to be a lot more difficult than a client who's got 10 buy-to-let properties in the background with semi-commercial experience as well. And as I say, these are the sorts of things we look at when we're in our guidelines as to, you know, is this something that makes sense for us to consider?
And as with any case in the specialist market, it's all about the presentation sometimes. So, which is
definitely
where we're very strong.
Really is.
How that case is presented to the lender can be the make or break of it. So, Charlie, thank you very much indeed. No more questions. So Simon will remove you from the room as a speaker. You can obviously still continue watching my nonsense if you want to, entirely up to you. But thanks very much. We'll see you very soon.
Thanks very much, Tony. See you soon.
Thank you.
Bye, everybody.
Okay, everyone. It's now down to me. Now, I've actually made some major changes to this, so please bear with me because some of the slides, I've only completed some of these slides about 11 o'clock last night. So because I wanted to just get some stuff that's up to date. And we're going to start off rather than we've done so many of these now, and it got to the stage where I was talking more about the FCA and I was talking about what's happening in the market. So I decided to change that completely. So I need to talk about the FCA a little bit, but just really, this is something we're just going to try out first of all, just something that what's been going on in the market over the last couple of weeks. It's very, very difficult to keep up with all the changes in the marketplace at the moment. Changes in base rates obviously means that there's been lots of changes happening to lenders' interest rates. But lenders it's still very, very competitive out there. And even though we've got base rates going up, we're still seeing rates reduce across a large number of the sectors that we deal in. So again, this is just really an overview. It's something we really just knocked together in the last couple of days. But if it's something that we feel is going to be of use to you, then we'll spend more time on it. And so next month it will be more detailed and probably a little bit more in depth and hopefully of help to you. So we start off just with some bridging. Again, if whether you're aware or not, Interbear have come back into the bridging market after a 2-year or almost 2-year gap. They pulled out of the market in 2020 during COVID. Rather unexpectedly, but if they now come back into the market and doing rates from 0.47%, which is not quite market leading, but it's not far off. So that's something of a plus at the moment. Only yesterday, Glenhawk have revamped their regulated bridging range. I don't know whether you're involved in regulated bridging or not. Massive market at the moment, and so if you're not involved, something maybe just make your clients aware that it's something that you can do. We've got whole of market access on the regulated side. And with Glenhawk, we've got a great relationship with Glenhawk and rates starting at 0.49%. And just onto Precise, they've also reduced their rates, being part of One Savings along with Interbay, also reduced their rates to 0.47. But the good news is, I've already mentioned about surveyors. If I could have a business where I didn't have to have surveyors or solicitors involved, I'd be a very, very happy Tony. I really would. So whenever a lender comes out of anything that means I can do away with one of those, and Precise with their AVMs, being an example, that is great news for me. And regulated bridging, they now will offer regulated bridging where planning permission is required. And we've had a number of cases over the years where we've had to actually turn them away because there wasn't that facility. So that's quite a big one for us because we do get a lot of stuff where people want to buy a property and want to carry out substantial works with it before they move in, for example. So great product from Precise. On to second charges, we've seen that most lenders, again, great news that they've improved their criteria for automated valuations, AVMs, which means they don't have to use the dreaded surveyors. Several now in a rate war, which we're seeing rates drop, which is great. Again, great news. Whether that will continue, because I'm expecting another base rate increase imminently from the next time they meet. So we are seeing obviously rates drop within this market. Most lenders are now also working very hard to reduce the amount of paperwork required, with a couple of lenders now being virtually at the point of being paperless, other than the mortgage deed, which has to have a wet signature, but everything else is electronically signed, which again is great news because we know what clients are like when it comes to sending them paper. And a lot of lenders now are following the lead from the buy-to-let market and are offering 5-year fixed rates with an ERC period that only lasts 2 or 3 years. So again, great news for the second charge market and second charge brokers such as ourselves, because it just gives us a lot more to offer. So there is a lot going on within the market at the moment. And again, like I said in my first presentation, if it's not not a product you're using, strongly urge you to do so, because you are missing out and you are giving away business to other brokers out there. On commercial, whether you're involved in commercial or not, we've seen Alica have now issued some 5-year fixed rate products at long last, after 2 years of just offering variable, which is great news. They launched their care home product through a select number of brokers, of which we're one. So that just gives us another string to our bow within the care home market. Not that we've got many strings on that bow at the moment, because it has proved to be very difficult over the last couple of years. And Alica will now look at about 99% of property types. There's very little that they refuse to do, farms and agricultural, but that's pretty much the case for most commercial lenders. And when it comes to semi-commercial, they will consider as little as 20% residential. And Charlie was just talking about they want to see at least 50% residential. Alica now have dropped to 20, which again just gives us another. They are more expensive than Hampshire on that product, but it just gives us another string to the bow where it falls outside what Hampshire will do. And Redwood, maybe a lender you've not heard of, a lender that we've had in our books for many years, have just reduced their rates by over 0.5% across the board. So on residential investment and commercial investment, 3.49, 4.49. They've also increased their LTVs as well. So they seem to be coming to the market in a much bigger way now. So hopefully we'll see some more activity from them. On the buy-to-let side, brand new product launched only yesterday from Catalyst Property Finance, for whom we are an approved packager. So you'd earn the same money from us as if you went direct. But of course, we know the people behind it. We know the owners, the directors, and will tend to get more business through. Rates from just 3.74. These are discounted rates. So the interest is actually that 1.5 or 2% is added to the advance each year. But it just means, especially with the rental coverage at 100%, just gives us more lenders in that marketplace, along with Octane, who we mentioned earlier, with their 100% rental cover. Unlimited top slicing, and they accept most property types, mixed semi-commercial, mixed use, holiday lets. So again, more competition come to that market. And finally, on the buy-to-let side, Castle Trust, who we had several exclusives through Castle Trust. 2 of those have now gone, but we still have the third one. 5-year fixed rate at 4.15%, valuation refund of up to £6,000 on completion, and property accepted pretty much anything. So they accept standard buy-to-lets, HMOs, multi-unit freehold blocks, holiday lets. And on the holiday lets, they don't use the AST equivalent income. They actually use the holiday let income, so which can make quite a big difference sometimes. And they'll also do first-time landlord, first-time investors. And also, this is an exclusive that we've got. No one else has got this. Title insurance up to £2 million. So again, if you've got cases that you're struggling with in that marketplace, then give us a call, because this isn't going to be around for too long, this product. I'm expecting more exclusives to come from them, but this one, not sure how long it's going to be around. And a little bit of news, I've got to mention the FCA, let's face it. It wouldn't be a specialist mortgage web show if I didn't mention the FCA. So as you can see, the news was that as yesterday, and you can see the picture there, that the FCA, for the first time in their history, their staff went on strike because the FCA cut their bonuses. So as you can see, I don't know if you can see some of the banners there. FCA staff ignored for too long. Well, now you know how we feel, don't you? Isn't it great? And there's one right at the back. FCA don't take our pay. We've been taking plenty of mine for years as well. So I have absolutely no sympathy for them whatsoever. They should not be receiving bonuses. They are a government agency. They are not there to get bonuses. They are there to do a job, which is to protect the public. And they don't do a very good job of that. And that's all I'm going to say about the FCA today. You'll be pleased to hear. So this is some information about us and what we can offer you. Pretty much, this is a partnership. One word that well, 2 words actually, I detest in our marketplace is master broker. Because it puts across something that, okay, a master broker, is it a servant? What is it? I mean, quite simply, we offer, it's a partnership. I have to rely on you to place business with us, and you have to rely on me to actually place that business and pay you when I say I'm going to pay you. Quite simply, it's that. So it's a partnership. We are in partnership, helping to get the customer the desired result, and then we achieve the desired result, which is to earn money from it. We want to help you grow your business. So there's various ways we do that. You see, we have a lot of giveaways. We want to make sure that you are up to date with what's going on in the market. And it doesn't matter what your FCA status is. The majority of our business does come from directly authorised companies. But we also see a lot of business coming from ARs. So if you find that you want to use us and your network is saying you have to use our network of approved providers and you don't like any of the network of approved providers, which we see all the time, then give your people within the network a call and say to them, why haven't you got Specialist Hub on your panel? Because we are approaching the networks, and of course some of them they've got exclusive with certain providers, with certain master brokers as they like to call themselves. I've got some networks where we've got 40 or 50 of their people giving us business on a regular basis because they do not want to use the company that they've been told they've got to use on unregulated business, which isn't right. We want to make sure you stay informed and stay compliant. Hence the reason why the GDPR, for example, we want to make sure that you're going to be around. I do not want another repeat of 2009, where not only no lenders, but also brokers just like going by, like just falling over like 9 pins sometimes and just exiting the market. Because if I haven't got people giving me business, then I can't place the business with the lenders that weren't there. But so we want to make sure you're around for a long time, writing business, hopefully with us. Our products, very simply, I'd rather than go for each, I just say what we don't do, which is we don't do equity release, and that's pretty much it. Everything you see there, we offer. And we do a lot of business with these marketplaces. And because we do a lot of business, we now have packager status with a lot of lenders, which I'll come on to a little bit later. In the second charge market, I believe I'm probably the second longest serving person within the second charge market now. It is 40 years next year, which I find absolutely horrific. I really do. But 40 years in one industry, and I've seen literally every change from what really was, as Matthew mentioned earlier on in his presentation from Pepper, it really was, when I first started, it really was like the Wild West. And regulation was brought in to try and bring it into line. So we had 8-day calling off periods, which were actually horrendous. We had to pay for valuations. There was no extra fee. You couldn't charge clients fees to start with, anything like that. But it really did, because it really stayed actually quite dodgy for quite a while. Those of you that have been around for a long time might remember Rule of 78 settlement penalties, single premium, joint premium, PPI, horrendous products, absolutely horrendous. But they've all gone. It's now a mainstream product. And you see, commercial, we do a lot of business within the commercial space. Buy-to-let second charges, we do a lot of business within that space these days. That's our key. So we're no different to really some of the other packages, I suppose, or some do like to call themselves master brokers. We are really no different. We are different in some ways, though, which I'll come on to shortly. And our service, quite simply, we can offer. My staff are experienced enough to do either or. So if you want us to give the advice, more than happy to. If you want to give the advice and we just package it on your behalf, more than happy to do that as well. It's entirely your choice. You can mix and match. If you know that you're going away in 3 weeks' time and you've got a case that has just come up, you might want us to give the advice because you won't be around for 2-3 weeks to actually deal with it. Again, we are very, very flexible. It's your choice every single time. And why are we different? Not the products we offer, just mentioned that, because we offer exactly the same products as everybody else, with a few exclusions. We've got the occasional exclusive. It's the people we employ. Minimum 5 years experience in specialist financial services. Absolute minimum. Won't get through the door without it for the interview. And it's not just experience, not 5 years working behind the counter at Nationwide. That is 5 years experience in our marketplace. And it's something I won't even entertain somebody if they haven't got that, if they're applying for a job. Multilingual, and I'm not going to try and pronounce the 5 different languages there because I never get them right and my staff laugh at me. But that comes in absolutely invaluable on occasions when we come across. And I've just actually found out there is another one to add to that as well, because I've just found out one of my staff speaks basic Hebrew, which came in very, very useful on a recent case where all the documentation of the client who lived in Israel came over in Hebrew. So she was able to see exactly what that was, rather than me using an app on my phone that tried to convert it and did a very bad job of it. The main thing, though, the reason this is underlined, is mature life experience. All of my staff are, I think my youngest member of staff is in her mid-30s. I don't employ people just out of school, just out of college, just out of university, because I just don't need the aggravation. I just want people that know what they're doing and actually can have a conversation. And you know what it's like. Sometimes you speak with somebody and you know they sound like they're about 12 years old, And you know by the end of that conversation how frustrated you can get because they're just not getting what you're saying. Well, my staff do. They will know what you're talking about, and their knowledge, you will find, is second to none. My longest serving member of staff has been with me since 1997, and she joined me when she was 17. So as you can imagine, and Kirsty's been in second charges pretty much ever since, her knowledge of the market as a day-to-day processor and completions of second charge cases is second to none. And this was a little bit of feedback given by an introducer partner, which he actually gives me every single time I speak to him. Most recently was last week. But he absolutely raves about it. I won't read that. You can, it's been on the screen long enough, but you can see exactly what it says. But his words to me, which I haven't put down there, I wish I found you years ago, because he said I've used some absolute clowns over the years and lost a lot of money because of it. Well, there you go. He's now with us, and he's earning regular income from it as well. Regular income with very little involvement, because he doesn't want to give the advice. And why are we different? Lender relationships, which I'll come on to in a while with just a couple of examples. But because I've been doing this so long, a lot of the people that I've grown up with in the industry are now in senior positions within the industry. So people that were BDMs in the late 80s, as an example, for certain lenders, are now sitting on the board of certain lenders or other lenders, and I've got that relationship with them. And that, it proves it's not what you know, it's who you know situation. That it proves invaluable sometimes. It really does. How seriously we take compliance. I've stopped actually putting the 2 slides up, which are our feedback from the NACFB, because you've all probably seen them like a dozen times. But we will be putting up a new one fairly soon, because we're about to have our latest compliance from the NACFB, and I'll be putting up the result of that. And I have no reason to expect it's going to be, well, I expect it to be better than the previous 2. How seriously we take the prevention of financial crime, and we do take it very, very seriously. We don't see a lot of it, but when we do actually do it right and make sure that people are brought to justice if the police wants to get involved, of course, which isn't very often these days. They don't seem to actually bother anymore, because when it does go to court, the courts normally let people off with a suspended sentence. So, but we do take it seriously, and we follow all the rules. And it's not our numerous awards in the financial press. We have never, ever won an award from the financial press. And the reason we never won an award is we never put ourselves up for it, because it is, you were seeing lenders today have said we've won awards, which is great, because I can vote for any lender. We deal with a large number of lenders, and we know which ones are the good ones. We know which ones are the bad ones. And I can vote for any of those. But it is award season at the moment. It seems my inbox is inundated with vote for me from lenders, which is fine. No problem with that at all. But when it comes to brokers, how can a broker win a best broker award if it's not being voted for by the people they've actually serviced? It's not. It's been voted for, and this is who's actually voting for these. And this is something I did look to see if I could find another one last night, but I couldn't, because I didn't have enough time. But this was one only a while back, only talking last year. And this was a guy put this up on his Facebook, because he put himself up for the What Mortgage Awards 2021, best broker, whatever it was. And he's asking his Facebook friends to vote for him. And he won it. He won it because his Facebook friends, his Instagram friends, probably all his staff, all voted for the company. Not the people they actually arranged like finance for, but the people that actually work for them or his friends. Absolutely wrong. It's about as corrupt as it gets when it comes to brokers, unfortunately. And I've seen some absolutely horrific situations. I was at the Awards Do once. It was a second charge Awards Do, and I was sitting next to one of the judges. And when it came to the best valuer or best surveyor award, he said to me, so-and-so's won this. I won't mention names, but so-and-so's won this, unanimous. And then when it was announced by the head of the company that was actually hosting the awards, it was actually given to another company who'd actually sponsored the awards. Not what the judge did. And the look on the guy's face next to me was, I can't believe they've done that. That's how corrupt it is. Best Newcomer Award was given at the same awards do to a company that hadn't even launched yet, but had booked 20 grand worth of advertising. That's how bent it is. So when you see a broker saying, I'm not saying all brokers have done anything wrong. Wouldn't say that at all, because I wouldn't know. But just treat it for what it is. Sometimes that it's incredibly difficult to vote for best broker when it comes to anything of this nature. So what else can we offer? We always offer designated underwriters from start to finish. We don't have a sales team. So if you phone us up and say, I've got this deal, it doesn't go into a sales team, then into an underwriting team, then into a processing team, then into a completions team. It's quite simply, you have one person from start to finish. And the only time somebody else gets involved is either that person's on holiday, or right at the end, you'll hear from me to say, case is completed, give us your bank details. Because we pay your commission immediately the deal completes, normally within 20 minutes, if we've got your bank details. That's all we need. We don't have a cash flow problem. I wouldn't expect to pass one on to you. When the deal completes, I'm a great believer in only picking a file up once. So when it's passed to me, it's to pay the commission. I don't want to be sitting on that file waiting for myself to be paid, for example. It's absolutely pointless. And also no commission clawbacks. In any A2 circumstances, we claw back commission if it was fraud, which only ever happened once, or if the customer cancelled the agreement within the 14. Some lenders have a 14-day period that allow cancellations to take place. So in that case, we would then ask for the money back. But I can't remember the last time I clawed back commission from anybody. It's been years. What else can we offer? This is incredibly important. It might sound actually quite trivial, because I know for almost all of you, when you speak to a client, you'll ask them for their credit report from either Equifax or Experian. Well, we have direct facilities with both. So that quite simply means when you phone us, when you get in contact with us with an inquiry, rather than relying on what the client has provided or relying on the client telling the truth, we can search, with the customer's permission, we can search that straight away, which means we're going down the right path straight away. You all know what it's like. Sometimes you've had a client say, yeah, I've got no problems at all. You start with a lender, and then a week later you find out that they've got half a dozen defaults and they've missed the last 2 mortgage payments. So you've wasted all that time on a case that was really not going to go with that lender you're trying to place it with. We don't have that problem, because right from the outset, we see where that case should go. And also, when it comes to second charge lenders, especially, if they do use a credit score, there's different types of credit score that they use. So we will know whether it will fit with that particular lender. So we do this at our expense right at the outset with the customer's permission, and it saves an absolute shed load of time, as you can imagine. And the other things we offer is that we were not satisfied with the quoting systems that were out there. And probably all of us will use Mortgage Brain, TriGold, or 27 Tech, understand that, for our first charge business. But what is out there for second charges, bridging, commercial, accurate buy-to-lets? Very little, to be honest. Very little indeed. And also, there's a lot of lenders that don't subscribe to the free sourcing systems, purely because it costs so much money to do so. So quite simply, we designed our own, which work perfectly well. We use them in-house at the moment. We are trying to figure out ways we can actually offer them on our website, so you'll be able to do the searching yourself. But these save, as you can imagine, the amount of time this saves my staff. They love them because it means they haven't got to do the research they'd have to do manually. And it covers whole of market. So it covers all those lenders that are out there that don't subscribe to the 3 sourcing systems. And for the bridging side of things, we've actually got something that can give you a comparison, for example, on 4 different bridging lenders for every scenario there is. So it saves us a load of time. And quite simply, if you phone us up, if you phone me up and say, Tony, I've got this case, I've got this bridge, these are the figures, about a minute and a half later, I can have a PDF quote in your email telling you what's available. It's as simple as that. Data security, we are very, very hot on that. As you can imagine, having what we thought we were hacked back in 2015, wasn't the case at all. But we are very, very hot on that. And we also offer full training, virtual or face-to-face, totally free of charge. If face-to-face, if it's within traveling distance, if you're in Newcastle, for example, don't ask me to pop up for a meeting, because I'll probably get a nosebleed if I go that far up north. But if it's local enough, I can do anything local face-to-face. Or if you are far away, certainly on this type of like a Zoom meeting or a Teams meeting or whatever your choice. Okay, our second charge panel, I'm not going to go through all those, but as you can see, we literally deal with everybody. We can offer those to you either on an advised or non-advised basis. And that is a major advantage. I mean, some of you might be involved in second charges and you go direct, but you probably only got access to 3 or 4. I'm not even going to try and count those, but I think it's close on. I think it's about 18 in total. And it covers every scenario that you can think of. So that's our second charge panel. Our regulated first charge panel, we've just added foundation home loans, family building society. We've been packager for some time, precise and together. So for those of you that have together cases that you can't place direct checks, they haven't gone back to the whole market, and fairly unlikely they probably will do so either. Come to us, and there's a very good reason for that, which I'll come on to in a couple of slides' time. Our specialist buy-to-let panel, there are more than that, but I haven't gone into all of them because there are some that we only offer to direct clients, because there's no point me offering BM solutions to you, for example, because you deal with BM solutions yourself. But that's our panel of, for the majority of those, on the next slide you'll see, we package. So for all those lenders, we offer a package service. If you want to give the advice, we'll do the work in the background for you. We'll make sure that the client will get the searches, for example. We'll make sure that client is going to be going to that, is suitable for that particular lender. And if you use one of these, if you do use Trigold, or Iris as they now call themselves, Mortgage Banker 27 Tech, just look out when you search for any of those, there are 8 lenders now: Family, Lend, Invest, Fleet, Precise, Foundation, Together, Land Bay and West One. Just look out if it's one of those that you're choosing, because we do not charge any fees whatsoever. And as a comparison on that, on my next slide, you'll see from the ones that we found, now this was done towards the end of last year, there might be some others now, but the lowest you would get from anybody out there was £95 from 3MC, all the way up to, I know there was one there, I think it's 299 quid as a packager fee. And this is up front. We don't charge any fees at all. As you can see on the bottom row, no fees for those 8 lenders. Our bridging panel, on advised or non-advised basis, I'll be honest with you, there are more, but I haven't got the space. But all of these are our sourcing system, and we can offer you quotes on all of those pretty much immediately. And our commercial lender panel, as you can see, pretty much covers from the high street all the way up to lenders. I mean, there's actually another one to go on there who really rotate the grotty stuff and the grotty stuff. So a recent client with 6 months missed payments on a second charge, for example, that was able to get away. So all of those lenders on our commercial panel, either, again, advised or non-advised. And if you do wish to advise on second charges, so second charges, you've been reluctant because of the fees that are charged within the market. Well, you can actually offer second charges, advise on second charges, and again, won't read all of those, but the last 2 bullet points, which are pay you your income on the day of completion and no loss in control, and again, no packager fees. We don't charge a packager fee if you are giving the advice on a second charge. You charge whatever fees you like. I've got one broker who charges £5,000 on every single second charge he does, if he's allowed to, depending on the size. I've got another one who charges £295 on every deal he does. Entirely your choice. It's whatever suits your business model. And our new guide is available. If you do wish to receive a copy of this, you could just type PROC type your message bit. And again, I'll be busy this afternoon sending out PDFs to everybody. But more than happy to send this over to you. This lists everyone, and this is as of it doesn't say on there, it's as of the 1st of May. It was updated last week. We'll email you a copy, and that includes not every lender that we deal with, but the main lenders we deal with, and what we are able to pay you either on a packaged or a non-packaged basis. I want you to be aware of the bandits that are out there. There is an absolute stack out there still. So if you are placing business through certain companies, again, I can't mention who their names are because I'll probably be sued. But you just want to make sure you're getting your fair share. This was the worst example I've ever seen. This was back in 2018 when we used to run our physical road shows all around the country. And a guy came to actually the show, wait until it finished, and came to me with an application in his bag and said, "This is a deal I've got. Does this sound right?" And it was a 1.4 million buy-to-let portfolio application. Could only go with Interbay at the time because of the client's circumstances. The delegate had been promised 0.5% commission on completion, or £7,000, as he was told by the master broker that Interbay didn't pay commission, which was a lie. The master broker's gross income, even after he dropped his fee from 30,000 to 24.5, was 45.5 grand, and he was giving away 7. Now, that's not illegal. It probably should be, really. And that is disgraceful, absolutely disgraceful. We did the case, didn't charge a fee at all. The broker partner, as we prefer to call them, we just split the 1.5%, we received 50-50. So we both went over 10 grand. He was happy. Client was ecstatic, as you can imagine. Absolutely over the moon because he saved himself 24.5 grand. On to some case studies. Now, I did promise last month I was going to try and update some of these. This is one that completed only on Friday, which is about as complicated as it gets. I won't read the entire thing, but I'll just read the. I mean, there was a Guernsey company involved in some loans that were made to the limited company that was the applicant. But the main thing was that the ultimate beneficial owner was based in Panama. And we managed to get this away, a £2.4 million deal with Yorkshire Building Society Commercial Mortgages on Friday. Introduce a partner, earned over £12,000 on Friday. Again, it doesn't really get much more complicated than that. If you look at the rate, 3.35 fixed for 5 years, in that circumstance, that's not bad. That's not bad at all, because it had been turned down by pretty much every lender they've been approached previously, not by us, but by others. So we've now got a broker who's obviously very happy because he was able to place a case that he was getting absolutely nowhere with. It was about chucking the bin. So that's just an example on how important it is on the presentation of the case, because we do know how to present the case. Another case study I did mention when Octane were talking earlier, just checking the time, they were absolutely fine for time. Did mention earlier on that there was a case study for them as well. This was completed last year. We've just come out of the second lockdown before we went into the third one. And this was a case where the rental cover worked out to 101% but because the client had, first of all, Octane will allow anything, as long as it's 100%, that's fine. But the client also had other properties. So we didn't have a problem offering it. We're not a company that will offer stuff to clients just purely because we can see pound notes at the end of it. We want to make sure it's right for the client as well. And on this particular case, he had other properties that allowed him to obviously make up shortfalls, but also it also allowed him to buy the third flat in a block of 3, so he could also then take on the freehold. So it actually increased the value of what he had significantly. Introduced a partner on that one and 32.5 grand from the advance. And I then saw, because he's a Facebook friend and also now a Facebook friend, also an Instagram friend, that he went on 3 holidays shortly afterwards, including a very nice tour of around Lake Como in Italy, probably paid for by this deal. So incredibly, very, very happy client and a very, very, very happy broker partner. This one, 75-year-old expat of HTB. He'd been living in South America, I think it was Chile from memory, for 10 years. Wanted some money to pay to fund his retirement and repay existing credit. Had no other property in the UK, so it was just the one property. We got a 2-year fixed rate at 4.03. We acted as the packager, introduced a partner, earned almost 4,400 on the day of completion. And I think this is the final. No, it's not quite the final one. There's one more to come. Application for bridging finance we completed in November 2021. If you don't know this one, because I have mentioned it a few times now, purchasing a 20-bed property that had planning for a 10-bed HMO. Not quite sure why there was 20 beds in there, but there were. Some of them were absolutely tiny. They were literally like a cupboard, but they were actually classed as bedrooms. But one of the biggest problems was that the neighbour had been stealing the property's electric for many, many years. That had to be sorted. So we managed to get that sorted. 10-month bridge was sorted, 2.15 million, no fees whatsoever, no broker or packager fees. And our introducer, because we have packager status with Roma, he earned the same as if he went direct. But obviously we covered off all the real technical stuff that was going through. He wouldn't know where to start. 21 grand he earned from that case. And now we're sorting out the exit. So there's another opportunity to earn as well on that deal. And as you can imagine, another very, very happy introducer. And I mentioned right at the start, this not what you know, it's who you know. Well, this is, I might have a better example than this coming up for a guy who actually was convicted of manslaughter in 2012. If it comes off, then it will probably replace this one. But this particular case, husband and wife business, running 2 very profitable children's nurseries. Mr. run the financial side, Mrs. run the looking after the children. And she was very, very good at it because they were doing an storming business. Really was a storming business. But he defrauded HMRC out of 850 grand. No, didn't pay tax and national insurance contributions for years. And it was only when a member of staff contacted HMRC to a technical question, they said, well, we haven't got you listed as working for that company. And she'd been working there 10 years. So a little investigation was done. They found out it was 850 grand. Mr. was arrested, sent to prison for 5 years. Claimed Clients then divorced, but all the assets that were in Mr's name, including both commercial properties, their home and some buy-to-lets, all subject to a Proceeds of Crime Act charge. Now, if you've ever tried to place a case with a Proceeds of Crime Act charge, it's a compliance department's delight. Gives them the chance to say, we're not touching that with a barge pole. Of course they would. So declined by multiple lenders and brokers across the industry. Came to us with reputational risk being the issue. So so this is what we did. We tried to do the same thing. We approached certain lenders, presented a certain way, no reputational risk. So contacted Together Money, declined by their compliance department. My underwriter contacted their underwriter, who then went to compliance, who said, nah, not touching that. Case handed to me as a decline. I looked at 55% LTV on the commercials, for example. I thought, we've got to be able to do this. It's 300 grand in the bank account. They needed raise about £1 million to pay off the Proceeds of Crime Act charge. A 10-minute conversation with a director Together that I've known since the late 80s. Won't mention his name. Gave him an overview of the case. He then went to the compliance department. As you can imagine, it's different when a director goes to a compliance department than when an underwriter goes to a compliance department, because there's a different power. There's a bit of a power shift. 10 minutes later, he came back and said, yeah, we'll do that. And we did it. And we paid off the Proceeds of Crime Act charge, both Barclays mortgages on the commercial, Northern Rock on the Northern Rock mortgage, which had expired as well on the residential, and the introducer earned just under 12 grand on the day of completion. The client has now been able to refinance back into mainstream because the Proceeds of Crime Act charge is gone. So incredibly happy client who now comes to us for buy-to-let mortgages through our broker partner. So, but incredibly happy client. And that one I'll probably be dining out on for many, many years, unless I can get this guy convicted of manslaughter through, which has proved to be a bit of a challenge. But hopefully, I'm still hopeful for it. And on that particular deal, this is what the broker actually said. I won't read the whole thing, but the service you and your team provided and continue to provide is second to none and world beating, quite simply. Because we managed to get a case through that every other broker had to turn away. So any cases you can't place at the moment, or it's something some stuff you've heard today, you think, yeah, this is something I'd like to do. Because obviously the reason we run today is we want you to partner with us to place your business on the stuff where you can't go direct, or also the stuff where you could do with a packager being involved. So if it's the standard mortgage lenders that we've mentioned, the buy-to-let lenders we've mentioned, we want to become your packager of choice. So if there's any cases, you can either leave something in the type your message box below, complete a DIP form that will be sent to you this afternoon, go onto our website where you can submit inquiries online, or go old school and just pick up the phone and speak to us. Staff are ready to take your call. You should have received, you are on LinkedIn, and when we've been able to find you, you should receive a request to, I don't want to say friends, it's not friend on LinkedIn, is it? A link on LinkedIn. And unless if your name's John Smith, we might have a bit of trouble finding you. So if you haven't received an invitation to link from me, can you send one back to me? Because there's not many Tony Suttons on there. But we can't find everybody, unfortunately. But we'd love to link, then that way you can see exactly what's going on in the marketplace. It's something we do keep updated regularly. And if you like what you've seen today, you will be sent one of these today, which is an agency application. We do not need this back to take a deal from you, but we do need it back to actually pay you commission. So get that back to us. If it's something you obviously won't have my name on it or have your name on it, but get that back to us as soon as possible. Our next mortgage show is on the 9th of June. It's normally the first Thursday of every month. We've got the Jubilee Bank holiday coming up. So next month we have West One, Alica, Selina and Catalyst are presenting. And next month is sponsored by West One Loans. And future shows, 7th of July, again, first Thursday of every month, all the way up to November. We also think of maybe doing some, I don't want to call it podcasts, but sort of like a one-to-one with certain lenders, only lasting about 20 minutes. So again, you'll receive details of that coming up. We're just trying to choose some lenders that we think, or some presenters that will be good for that type of thing. Feedback and CPD. I mentioned this right at the start today. When you leave today's session, just click the event board button in the top right corner, and then click exit event box, complete your feedback form, and the CPD certificate will come out to you thereafter. Ignore the bit where it says enter your name. You don't need to enter your name anymore. I need to take that out. I'll keep forgetting to do so. But that will come out to you automatically. If you don't get it, contact us tomorrow, and we'll just make sure that's sent to you manually. A little bit of a request. Obviously, a lot of time and effort goes into doing these shows. We don't charge lenders or delegates a penny for doing so. If you can help us out, either just go onto Trustpilot and search Trustpilot Specialist, or search for Specialist Hub, or Google for the Google review. Just leave us a review if you like what you've seen today. That would be absolutely fantastic if you would do so. Just gives us obviously a few more stars with those particular organizations. So, but just be careful if you do type that in. There's a firm called Specialists with a plural hub who've are in something completely different, and they've actually now stopped trading, I believe. So if you can leave us a review, would be much appreciated. A big thank you to today's sponsor, Hampshire Trust Bank. I don't call them HTB anymore because it gets people confused with Help to Buy. But big thank you. It's first time we've had a sponsorship, and big thank you to them. And you'll see there is something just behind me that I forgot to put up this morning. So we'll get something better sorted out. That looks a bit tacky. It's not Sky Sports, let's face it, is it? So, but we'll get something else designed. And finally, enjoy the rest of your day. Until next month, stay safe and prosperous. Thank you very much indeed for attending.